Are we Gucci or not? No. No. We Gucci. Okay. I think we need to lower this. It seems a little loud. Make sure the chat is on the right mode. My ear is cooked. God damn. I never can't even speak. Might never be able to hear again. New weekly. Dumb. Oh, you're right on time. God damn. I mean, in terms of where we left off, like really nothing went on the whole weekend, right? My usual shit. You had a couple little scalp opportunities along the way if you were sitting here looking at this shit. Oh yeah, our levels. Whoops. Right about the levels. What? What? data feed is broken. So I don't know how long the stream's gonna be either. Like the other day, I didn't realize how much that stuff was making my ear hurt. I took my headphones off and I was like, God damn. And what the fuck is wrong with this shit? It's weird though, like the pain has gone away. Most of the physical pain around my ear has gone away, but it's still like I can't hear shit. I don't hear shit. Probably just gonna watch one or two videos because there is 2 new videos we need to be watching. There's a new trading strategy chart fanatic video. There's a new interview. Actually queue those up. If there's nothing really going on, we're probably just gonna get heavier.
Stuck in the break.
Okay. Do these levels look correct? $885. Does that sound right? Yeah. Okay. that little pause. Send a text real quick. We'll be on our way. Okay.
If you are a novice trader, someone who's stuck in the break-even hamster wheel or unprofitable hamster wheel, you are mimicking what a trader does, but you do not have the complete picture. This is, I think, what separates proficient traders from novice traders, is novice traders do things that mimic trading. They open up their brokerage account, they open up a chart, they might know how to draw lines, and then they start clicking around and taking orders, all things that proficient traders do. But
introducing the 15-year trading veteran, also known as the Traveling Trader Z. In this episode, Z will break down this strategy step by step, keeping it simple, repeatable, and universal regardless of time frame or asset class.
Day trading, you are always in survival mode. Always, 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 always. And for a new trader, this is horrible. I think people turn into pattern traders. They're just looking at IFVG or an FVG and thinking that every single one means something. Most of them mean nothing because you have to align yourself with.
You will no longer be randomly pressing buttons. After this strategy breakdown, you will be able to tell a story within the market that will allow you to have edge.
Regardless of whether you're trading options, day trading, swing trading, whether you're optimizing long-term investment, you need to be telling a story. So what does that story consist of? That story consists of
Welcome everyone back to Chart Fanatics, the go-to channel for all the very best strategy and concept breakdowns with the best traders in the world. Talking of which today, we are here with a very special guest, someone I'm very excited to shoot with. We shot a podcast about over 18 months ago, and ever since I've been trying to get him in the studio again, and we finally did it here in New York City. He's a true trading veteran of over 15 years. He has worked on Wall Street, an incredible trader. He is known as the Traveling Trader, aka Z, or the other way around, Z, aka the Traveling Trader. But today, he has a phenomenal playbook to share with us today. It's the Universal Playbook, meaning this is a framework that you can use on any asset, any time frame, any style of trading to be able to create a narrative. And then we're going to talk and go deeper into it in terms of risk management, in terms of fundamentals. I'm super excited. I know you are as well. Without further ado, let's take it over to Z.
Thank you for having me, man. It's good to be back. So when you asked me to be on this podcast, I thought about coming here with my day trading strategy, right? Day trading is something you do every day. You do it for hours on end a day. It's the model that you're most familiar with, right? I know it like the back of my hand. However, I know that you've already had guests on here, some killers in the day trading space that trade some form of ICT or SMC derivative. Obviously, they've created their own models within that. But when I'm day trading, I'm using very similar models, even though I've created my own model around that. But I didn't want to bring yet another SMC or ICT derivative to the show. And I'm sure you will have more ICT, SMC traders in the future. You're familiar with my channel. Maybe some of your audience members are not, but we do a lot more than just day trading, right? We trade options, obviously trade futures, do option selling, optimize long-term investing, and I talk a lot about macro. And I talk about macro within the framework of trying to find trades and optimize investments, right? So then I started thinking about what is it that I can bring to the table? When I'm looking at all these charts daily, weekly, I'm looking at futures, I'm looking at options, I'm looking at stocks. What am I approaching the chart with? I'm looking for something every time I'm looking at a chart, but I've never really wrote it down. And I've been trading, like you said, for over 15 years. So it's something that I really had to sit down and monitor my thoughts and document while I'm looking at a chart, what the hell it is that I'm actually doing. And this is a universal playbook. This is my playbook for how I approach every single chart. So should we start?
Of course, yeah.
Okay.
Where's best to begin?
Okay. So here is the universal playbook, and we'll dive into, please excuse my handwriting, but we will dive into the charts later. I have some examples of trades that I'm currently in, trades that I've taken, and we could dive into the charts in a minute. But let's get into what are the basics of the universal playbook, right? So anytime that you're looking at a chart, you are trying to tell a story. I don't care whether you are day trading, whether you are swing trading, you are trying to tell a story. And this is, I think, what separates proficient traders from novice traders. Is novice traders do things that mimic trading. They open up their brokerage account, they open up a chart, they might know how to draw lines, and then they start clicking around and taking orders, all things that traders do, that proficient traders do. But these are just, you are likely, if you are a novice trader, someone who's stuck in the break-even hamster wheel, or unfortunately the unprofitable hamster wheel if you're just starting out, you are mimicking what a trader does, but you do not have the complete picture, right? And proficient traders, even if they're day trading and they don't know it yet, they are telling a story. They have conditional statements that they're looking for. If this happens, and this happens, and this happens, and I have this confluence, then I enter a trade here with a stop limit that makes sense and a take profit that makes sense. That is a story. No story, no trade. So regardless of whether you're trading options, day trading, swing trading, whether you're optimizing long-term investments, you need to be telling a story. So what does that story consist of? That story consists of, number one, a liquidity, what I call a liquidity catalyst. This is number one, foremost thing that you are looking for. So when I talk about liquidity, I don't mean liquidity just in the ICT term, right? Like a buy side, sell side liquidity or fair value gaps or whatever. I mean, liquidity includes everything. It includes old highs and lows. It includes key levels. Now, these key levels can be, you know, obviously if you have a support zone that has been tagged multiple times, right? This is a key area of liquidity. Why? Because you expect there to be quite a few buyers and or sellers at that level, right? You might be trading a bounce from that level. You might be trading a break and retest of that level. This is a key liquidity level. So old highs and lows, key levels. You obviously have the SMC framework. Yeah. You have trend lines. This is also a form of liquidity. So I don't care what strategy you're using, right? You were trying to tell a story around liquidity. That is all you're doing, right? The next thing that you want to see once you have a liquidity catalyst, you want to see, one of the things you're looking for is a big move. Now, when I say a big move, I don't mean that you need a big move in order to formulate a trade. I'm saying in your story, one of these things, one or more of these things is what you're looking for, right? So if price is trending, for instance, and you're looking at a chart, there's really nothing for you to do here.
Yeah.
Let me just There is no trade here, right? You don't have something that is catching your eye. Now, what if price does this? Obviously, your mind is going to be your thoughts are going to be percolated like, oh, there might be something for me to do here, right? So a big move is obviously a catalyst that you might be looking for. When we dive into the charts, this will make a lot of sense. But you were looking for a big move. Another thing that you might be looking for as well is market structure shift, right? This is all part of
Why'd you write that?
this liquidity catalyst, right? A market structure shift is a liquidity catalyst. So when you have a trending market that is making higher highs and higher lows, right? What happens when the last higher low is breached? That is a market structure shift, right? Similarly, when you are in a downtrend and you're making lower highs and lower lows, what happens when the last lower high is breached? That is a market structure shift, right? These are all catalysts that your eyes are looking for. Otherwise, if you are just in a trending market and you're looking at this and you're like, what trade can I take today? You can't. Nothing has happened for you to react to. So you are looking simply for a liquidity catalyst, right? That regardless of what strategy you're trading,
Can't
you're
wait
looking
to
for a
see all this
catalyst in order
liquidity.
to alert you of something, right? A big move obviously will alert you of something, and this usually
Yeah, I'm waiting
happens.
for this guy to talk about this thing.
This usually happens towards or from a major liquidity level, right? Big moves don't typically just happen out of nowhere. So it's either going towards an area of liquidity, or it's coming away from an area of liquidity, targeting the next area of liquidity. Now, the other thing that I want to know is price trending or not? And that's it. If you don't have one or more of these things, right? You need a liquidity catalyst, a price move towards or away from one of these highs and lows, key levels, a big move, market structure shift, whether price is trending or not. If you don't have one of these things, I don't care what your strategy is, you do not have a story. If you don't have a story, you don't have a trade, right? So this is essentially the framework for what you're looking for. Now, when you enter a trade, the next thing you're looking for after being triggered is a retracement. Now, there are breakout traders, and I'm not one of them. I particularly don't really like breakout trading, meaning if you have a certain level and that level has been breached, you will find people that will then enter a short here in order to continue it, right? I don't particularly favor that because regardless of whether you are trading, and I'll show you this on the chart, we'll see how this plays out in real time.
I mean, that's pretty late
Whether
for a
you are trading
breakout.
trend lines, right? Say you have a trend, that trend has been broken. You will typically see a revisiting before that happens, right? Whether you're trading break and retest, it's in the definition of the name, break and retest. It's not break and take a trade. It's break and retest, right? You break this, you're waiting for the retest. Even a lot of ICT type concepts, right? You have like the 2022 model when you have consolidation, right? Manipulation. And then you have a break of structure and you are waiting for a retracement into a fair value gap, right? Retracements are very optimal because if you are wrong, let's say that you're wrong, and I'll show you some examples of how I was wrong on some of these trades, right? If you are wrong, and let's say you're playing a break and retest, if this breaks and it retests and you enter here and your stop limit says above this high, say you enter here, the distance between this and this is not very far, right? If I entered here and now I'm going to suffer this entire retracement back, including my stop limit, that could be double or triple the distance that you're looking for, which translates into hundreds or thousands of dollars, right? So I'm looking for retracement after a liquidity event. And then the last thing I'm looking for is confluence. And confluence can be technical, and I'll talk about some technical confluences that I use, and it can be fundamental. And I'll talk about how to get better at fundamentals. This right here, maybe because of the nature of my channel, is one of the #1 questions I get. How do I get better at fundamentals? What books do I read? You are not going to get better at fundamentals by reading books, right? Like I have a finance background. I'm not really relying on what I learned 20 years ago in order to look for fundamental catalysts today. Now, I may understand things, I may be able to interpret or ingest that data easier because of the finance background, but I will show you a way, an instant way in how to get better at fundamentals that nobody talks about or thinks about. This right here is the playbook, right? I don't care if you're trading trend lines, break and retest, ICT, you are doing this. This right here is what you are doing. And this is your story. And this is the universal playbook that works on every time frame, every asset class, it does not matter. You are doing this, and without this, you do
Like,
not have
I
a
don't get
trade.
what he means by fundamental. Like, I don't think if you're like scalping on the 1 minute, I don't think it's particularly relevant. But I guess we'll see what he means.
You were just clicking buttons. You were just messing around.
Up to 6 million in futures funding. That's only possible at one
Just
place.
have to
Apex
wait
Trader Funding.
and
You can
see.
get up to 20x. How charts we've done, but also know when to trade in.
Beginning, the story is what separates those novice traders from those more proficient traders, because without the story, you're essentially gambling. Like, you're just picking certain confluences probably that you've learned online or from some mentor that you may have gotten, and just honestly trying, just trying things, versus the story is essentially the context, right, of what you're looking for on the chart. What is the story you're getting from the markets? And then, to be able to tell that story using these concepts right here. And a lot of them go hand in hand, right? So like the liquidity catalyst, for example, can create the market structure shift, which might have taken, which then puts you into a trending market, for example, which starts off a big move, right?
That's exactly it.
I'm on it.
That's exactly it. And the when we get into examples in the charts, exactly what you said is what you're going to see on the chart.
Exactly. And then, like you said, that's phase one, right? Of the, that's the foundation. From there, you can then look for your retracements in terms of like optimum execution points. And then, of course, having your confluences from a technical and I would say very importantly, the fundamental perspective, to then have a lot more confidence behind your trades, to be able to execute your trades, manage your trades. Because to your point in terms of the retracement, the people who are, you've got price and it breaks through. People will say, oh, I execute here because sometimes price doesn't come here, right? Mm-hmm. And I think that goes back to your point about the story, is that it's about you trying to tell the best story possible of why is it better for you to enter here? And even on those times where price doesn't get back, I think the point to highlight is that it's not your story then, right? Your story is not going to play out every single time. The whole point of creating that context and that story is that it's creating a higher probable trade for you, a better risk to reward model for you, versus, okay, yes, part of the story is played out at this point down here. Yes, you could execute here, but have such a skewed risk to reward that it probably takes away from that story, and that context really changes. And over time, probably in terms of execution wise, maybe not got as much profitable edge, maybe even just more break even over a longer period of time. And I get the hesitation of people of like, I'd rather enter and not miss a trade. But in reality, the amount of times you will get that retracement is going to be quite high, I would imagine. And the times you miss the trade, I think that's like a good misconception, is like you haven't missed it because it wasn't your trade. Like, it wasn't your story in the context you planned out. So you haven't missed anything. It literally was not the trade for you, like the one that you had actually planned. I think that's a problem where most traders are constantly trying, or at least the novice side, is they're constantly trying to get every single move the market makes and think that's what trading is, when in reality it's about, as you say, creating your story and then following. The whole point of doing this process is that you created a narrative that you're then looking to execute on. And if the narrative doesn't come through, it's just not a trade for you, and that's absolutely fine. You just move on to the next one. The beauty of this, this playbook, the universal playbook here, is that, as you say, doesn't matter about your time frame, because if you're scalping, you're doing the exact same process. If you're day trading, same process. Swing trading, same process. It doesn't matter whether it's futures, options, forex, crypto, doesn't matter. Like, the same principle has to be followed.
100%. Yeah, and you got it definitely with that. Like you hit the nail on the head. Fearing that you're going to miss a trade is not going to work out for you well in the long run. Like, if you actually back tested the times that you entered something early, your win rate is drastically cut, right? And you are also entering more trades. What people don't understand is every trade is its own risk proposition, right? And so the more trades you enter, you're opening up yourself to risk every single time, right? And people don't really get the context of what it takes to be a profitable trader over the long term. Most elite traders will hover in the 50 to 55% win rate range.
Yeah.
Right. And you're focusing more on your R multiple. You're not focusing on your win rate. We're dealing with a very high frequency industry, right? I make this metaphor all the time, but take basketball, for instance. Thousands of shots are put up by the same player every single season, right? An elite 3-point shooter shoots 40% from the 3-point line. That person is elite, right? An elite trader will trade 50, 55%, some 60, but usually over the very long term, you're hovering in that range. Yeah. You know what I mean? It's very different than surgery, which is not a high frequency environment. You were doing one surgery a day, sometimes one surgery a week, depending what body part you're working on, right? It's very precise and slow. If a surgeon had a 50% win rate or success rate, they'd be out of a job. If a trader or a poker player or a basketball player, if they're shooting 50%, they're elite. And it's can you stick with that over the course of years?
Definitely. And a big part of that
It's not even true, though.
Their discipline to the process, right? Because even the elite basketball players, for example, a lot of people won't notice that. They won't notice the stats. They'll just remember the good times, the game-winning shot, etc., or like the really record-breaking game that they had. Versus, I think there's I can't remember who the stat was with, whether it was Michael Jordan or Kobe Bryant. I think it was Michael Jordan, if I'm not mistaken. It was like he's he had failed more shots than he actually made over his career. But people just don't look at that. They don't look at that stat. And I think it's important, as you say, like when it comes to win rate, it's a fluctuating thing. There's going to be times where even if, let's say, your average is around that 50-60% mark, around there, or I always say to people, maybe your average will probably look at 40 to 60 within that range. But there'll be times where it'll be as low as 30, right? But there will also be those times where it's as high as 80. But that might be for a week, a month, right? Maybe if it's a really hot streak, 2-3 months. But it always balances back out again. Normally that 80% is followed by that 30 and vice versa.
Exactly. Exactly. Yeah. There are periods of variance, but then it tends to smooth out over time.
Always, yeah. And that's where the long game comes in, right? But by having this context right here is so important. I think that's where, as you say, the confluence, especially your technical fundamentals come in, especially if you consider it this year in particular, with the change in sort of the market conditions and cycles. The people who didn't have the fundamental knowledge or awareness or know what to look for or what it means, very much so blame the market a lot of the time. Because of their lack of knowledge and awareness, they'll say the market's changed, the market's choppy, the market's no good. When in reality, it's just a knowledge gap, an awareness gap that needs to be filled. Where do we go from here, though, would you say? So this is the foundation. Where do we move on from here?
All right, so why don't we do just a quick visual of what this can look like, right?
And I'll clear it off, sure.
Sure.
Yeah.
Sure. People can take a screenshot and follow along.
Exactly, yeah.
One of the confluences that I like to use is divergence, right? Divergence between pairs. Now, this is not going to be applicable on everything you trade, right? But if you're mainly trading NASDAQ and S&P 500, and I'll show you the swing trade that I currently have open since the beginning of April, is on the NASDAQ, right? So one of the confluences that I like to use is divergence. Now, we had the S&P 500, right, rallying from the election. This right here is for those of you that were long the market, right, this is a very fundamental, we could say fundamental catalyst.
Okay, fair enough.
But it's going to rally from a technical level, right? So if we hit, for instance, an old support level, and this is where we begin the rally from, we rallied into the inauguration, right? Now, when we rallied into the inauguration, another fundamental catalyst that we see is seasonal weakness after the inauguration in the first year of a presidential election. Now, you would only know that if you actually did, and I'll show you how to do research on this stuff. You don't need to read books. You don't need to subscribe to Apollo or Carson or Bloomberg or any of these firms that cost thousands of dollars a year. You could do your own research and start asking questions like, what happens typically after the inauguration on the first year of a presidential election? Oh, you tend to see seasonal weakness around February, right? So we have this trend line, and we broke. This now becomes all-time high, which is a key level, even though it didn't exist before because it's a new high. Yeah. But now that's established, that is an all-time high level. So we broke that trend line and we retested it, right? And we went down on the S&P 500. We went down to one of these old lows. This is where we stopped at. Now, the distance between here and here, and I'll show this to you on the chart, was minus 10%. This is another fundamental catalyst. If you look at the history of the S&P 500 or the NASDAQ, mainly the S&P 500, the NASDAQ's a bit more volatile, but it tends to stop at these psychological levels, minus 10% bounce, minus 20% bounce. You see this all the time, and I'll show this to you on the chart. This is not something I'm making up. So this right here was a protruding low, what we call an internal low, is a form of liquidity. And this is where the market rejected off all-time high,
protruding a low was
catalyst, retested the trend line, right? And we dropped to that 10% level. This is an example of how you can use fundamental catalysts to tell your story. The break of the trend line in and of itself is a liquidity catalyst. The all-time high is a liquidity catalyst because we put in a fresh high. And here, by the way, on this trend line break, we also had let me do it in a different color. We had a market structure shift. So I don't care if you are trading trend lines and you played the retracement into the trend line, or you're trading market structure shift, like sort of like an ICT 2022 model, and you are trading the retracement back into an order block or fair value gap, right? You are using the same. You're really using multiple strategies to tell the same story.
Exactly. It could be head and shoulders. It could be Fibonacci. Yeah. But it's all, as you say, the context of it, and back to your point, the story of it remains the same if you boil it down, right? If it doesn't matter the labels and the type of strategy you're using, whether it's ICT, SFC, whether it's technical patterns or Fibonacci, even there could be indicators that are around the same point. But as long as you have the context and the story, as you mentioned, which derives from like understanding the trend you're in, what liquidity has been taken, the fundamental catalyst is very helpful in this case, in particular. And a lot of the time, the larger moves, and I would say a lot of the time, the cleaner moves. It may not feel like it when that 1 minute candle is just printed or some sort of news has just broken. But in reality, when you take kind of a little step back and observe everything that's happened, a lot of the time, the catalyst has been from a fundamental perspective. And as always, well, as always, but majority of the time, the technicals and the fundamentals sort of align. It's just kind of getting, I think, as we talked about earlier, having that knowledge gap is the problem, because if you don't know what's going on or why something's happened, even if it's not a case where in the moment you knew, as long as you're able to sort of, as you say, like be able to research and ask the right
And you
questions,
guys are
you can
yapping
get the
right
answers,
now.
and by just having that, gives you a lot more peace of mind.
30,
at least
30
more
minutes
clarity in the
in,
markets.
that literally said
Because when you have
nothing.
that knowledge gap and that happens, let's say this whole scenario is taking place, you could
God
just be giving
damn.
into a lot of panic and a lot of emotional fear from reading headlines or reading tweets when you don't actually know what's going on or why something's taking place. And as you said, a lot of it can be seasonal. A lot of these things, can be just literally looking at past data from these seasonal
It's
events.
one
And being
hell of
able
a
to,
yap
like this one in
session.
particular, like the minus 10%. The amount of people who started reaching out to me when we had this sell-off, saying, "Oh, what do I do? Do I sell my stocks? Do I sell my pension, etc.?" And I'm like, "Why? Like, this is very normal. Like, if anything, these are the best points to potentially buy." And I struggle. I try not to say it just in case you get, as you say, a 20%.
Yeah.
Right, which can easily happen. And if I tell them to buy 10, the next thing
pretty
that's going to
yap.
happen is they're going to message me when
Mm.
we're at 20. So I try not to. But in essence, though, I'm not panicking because, again, you look at the history. But I'll let obviously you go into that in more detail. But I love the
100%. And in terms of like, because one of the things we do is also optimize long-term investing. So most people, when they invest, right, they're putting a dollar cost amount average, 10% of their paycheck or whatever, and that's perfectly fine. But you can supercharge your investing. Like you said, people that reached out to you about the minus 10% or minus 20%. Anyone that's in the stock market knows family and friends that will reach out to them. What do I do now? I hate giving people advice, and not because I don't believe in my analysis, but because I know they can't react to it well.
Yeah.
You know what I mean?
That's a prime example, right? So if it's 10% down now, they're wondering, should I sell? And if let's say I'm mentioning, it's probably a good time to buy. It's always a good opportunity where you could buy some more, right? If you have a long-term view. They then buy, drops another 10. They don't understand that that's another great opportunity. Or at least it's not something to panic about. As you say, they don't have that time horizon. You don't know their time horizon. You don't know their situation. So it's actually a really difficult position to be in, because you spent all this time building this knowledge. So when people do actually, you have sound knowledge to give, but it's just when people don't have that knowledge themselves or awareness of the markets, you don't know the time horizon. You don't know how diverse they are in terms of how much money or capital they've put in, etc. Plus, a lot of the time, the whole reason they've hit you up is because they've seen a headline on the news or on Twitter, or someone's text them saying it's all over. It's chaos now. So they're not really in the most stable
1-0
position to receive advice as well, I think.
Let's take a break for a minute there, guys, because I want to tell you about the best CFD prop firm in the
About
entire
to get a
industry.
30-minute candle. Okay. Is this thing gonna fill the gap or what? How's everything else doing? Palladium still pumping. Okay. Interesting.
Industry, Funded Next. Funded Next is a proud sponsor of Chart Fanatics, and they have been leading the CFD run for info. You get just a panel of more patient. They have some compensation funded.
I agree on a yeah, and I'll show you.
Traders, welcome to Funded Next. The link is in the description below. Now let's get back to the episode.
I agree, yeah, and I'll show you a way in which I do fundamental analysis as well. But to your point, and this is kind of going off on a tangent. But if you look at all the major crashes and corrections, right, that 2008, 2020, whatever, if you just bought the high and you did nothing, right, or if you just sat on your stocks and you panicked on the way down and you did nothing, then we eventually get to that high. 2008, I think it took 6 or 7 years before we hit that high. What do you think is the result of someone who bought in 2008 or 2009? Not only are they profitable immediately, it is a stupid amount of money. I tell people this all the time, and I'm very honest with my audience. I've made way more money swing trading and investing than I have trading. Trading to me is just an income. It's a way to generate income. It's not a way to generate wealth. You cannot beat the compounding effect of the stock market. You cannot beat the fact that you don't have to manage your risk super tight like you do in a day trade, right? Like if Apple falls to, I don't know, say Apple falls to 120 and I buy Apple 120. Do you think I'm setting a stop limit there? I don't care. I'm going to hold that for 10, 20 years. And it compounds and compounds. $800 billion companies become $1.5 trillion companies. They become $2 trillion, $3 trillion companies. Now we're knocking on 4. You cannot beat that type of effect with day trading. So day trading can get you a nice income. That income, you throw that into the stock market, and using the same principles that we're talking about here, you can optimize your long-term investments like someone who is telling a story through their trading, right? Like I'm not a dollar cost averager. I go in heavy at certain points when certain things happen, using these concepts.
Yeah, definitely. Well, let's talk about the pros and cons of the universal playbook, and then jump straight on the charts, I think.
Okay.
Yeah.
Yeah. Now, in terms of cons, there are some cons depending on what it is you're trading. So, for instance, I recently took a loss on a trade. I actually had to roll the option, so not necessarily a loss, but more of a loss than I wanted to. It was on Uber, and if we have time, we can go into that. I do want to share some more charts before that, but the difference between swing trading and day trading, right? So here's swing, and here's day trading. So we could say, where's the pros?
You should
And I'm not gonna
change the
include
format of the
investing here because
video.
you're
There should be another
essentially buying and holding.
professional trader there to keep the other trader in check. That would be an interesting conversation. Like keep what in check? It's this guy's strategy, nothing to keep in check. Each person can do whatever they want. One guy showing off his strategy can be boring. I mean, that's the point. That's the whole point of the series. You should just watch another episode or something.
Holding at the lows, right? So the pros with swing trading, more deliberate, right? You inherently have more time to make decisions. You are less prone to panic. Now, one of the cons of using this model with swing trading, sure. One of the cons with using it is that
I'm in check as in focus on the strategy. Yeah, but like not everyone that's watching this channel knows what they're talking about. Like, I'm sure there are plenty of people who are like listening to this for the first time and are like, "Oh, interesting. What is this guy saying?" Like, yeah, if he's gonna sit here and explain like moving from like liquidity to liquidity level and like market structure shifts, like, yeah, I learned that like the first week.
because you are trading derivatives that usually only trade during market hours. So say you were trading options, right? And this is a play that I recently took a loss on, even though the setup was A+, is you have no control in the after hours.
Not for long. Not for long.
Right? So if I take a position on, so Uber was a just
Actually, I don't know that.
break and retake.
Like I know they're enabling the Nasdaq to trade 24/7, but like, does that also include the options market as well? Out of curiosity, maybe it'll depend on the broker. I like the microphone volume today. I haven't done anything with it other than didn't even use this computer since the last time I streamed. Options on Robinhood and that 4/15. Yeah, I know it depends from broker to broker. Some let you go a little bit later, some don't. I'm curious with this whole change to the Nasdaq, are they going to be changing that? According to ChatGPT, just based on what's been currently announced, no. Interesting. For most of the stocks, 415 on select stocks. But one of the videos on here, a guy was saying you could trade it later than that, or was it? It was the options one. This guy, I forgot what time he said, but I think it was later than that. But he said it was only one specific brokerage you could do it on. Think you could do it to like 5 or something?
Test. So made a high. There was a level here, a very, very, very strong level. And I was playing a bounce, right? Off of this level. Uber ends up tanking in off hours. So when it opens here. Now, if you're trading options, you don't have control over that. And you can bake it into your risk to reward. But when you are trading options, you have to provide yourself a cushion when swing trading options. Because a lot of time, not a lot of times, often, or can be, what happens is price opens up below where you were going to set your stop, right? Now, you cannot really set stops in options, right? I don't know if you've talked to options traders before. You can, but it's not ideal because options pricing is so erratic that it's not exact like
Like
futures.
size for zero, right?
I typically don't size for zero, but I allow myself a cushion. So I'm not going to set a stop limit based on the price of the option.
Okay.
I'm looking at the chart, at the stock chart, in order to determine whether my play is still valid, right? But it can open up below the level that you were expecting to sell at. And say it opens here. And now instead of being down, if you have roughly calculated it to be down 25 or 30%, now you're down 45%. And you have to build in this cushion. And this is one of the biggest mistakes that I see novice options traders make is they size for zero and they take a big size, right? Or they take a bigger size and they don't account for the possibility of this happening because you have no control in the after hours, right?
I mean, sizing for zero and big size is like two different issues, right? You can size for zero and not do big size. Bitcoin options are 24/7. Futures options 24/7. I mean, they still close on weekends. At least CME ones do. It'll be interesting though. It'll be interesting to see how this develops. You know, the post blockchain world enables this stuff. And they're going to be adding perpetual futures for like traditional equities. Like you can already do it on Hyperliquid, and even Bitget you can do it too. But like Coinbase announced they're going to be adding it. They've been talking about making everything 25/7 for a long time. Yeah, but they're actually doing it though. It's already like confirmed at this point. Like when does this start on the Nasdaq? It's like some point this year, right? Goddamn ads. It's set to launch in the second half of 2026. They're also doing it on the New York Stock Exchange actually for 22 hours a day.
Now, this relates to options specifically, but pricing is not exact. So with stocks, with futures, you know exactly how much you'll be up or down, right? Because it's just absolute based on the level. If you sell here and you buy back here, you know exactly how much you made. If I bought a SPY put here and I sold it here, I don't know. Did I make 15? Did I make 30%? You don't know. It's based on Greeks, implied volatility, theta decay, expiration date, strike price, etc. This is why, as a side note, it boggles my mind that people get into options trading before futures trading. And then when they approach futures, they're like, this is confusing. I'm like, how is that confusing? You can only long or short it. With options, you have to pick strike price, expiration date, etc. Right? So those are the cons. And then another con that I think affects novice traders, not proficient traders, is this aspect of more time gives people more time to get in their own way. So a lot of times your play is in play when you're looking at a chart, but because it hasn't made the move yet, you are more likely to act prematurely.
Got you. Yeah. You gotta have that patience and wait.
You're more likely to act prematurely. And so the pros with day trading is that you are going to close your position in the same day. So you don't really have no after hours risk. Right? The cons is that it's the fastest form of trading. It's by far the hardest form of trading. More panic. The fight or flight system in your
I
brain is
mean, what
triggered.
does he mean by hardest? I don't know if that's necessarily true, is it?
Whereas with swing trading, it isn't. Right? When I'm swing trading, when I open up a position that I plan to hold for weeks, I don't have fight or flight. The survival part of your brain is not kicked off yet. Day trading, you are always in survival mode. Always, 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 always. And for a new trader, this is horrible, right? Like you should be paper trading. Now we have prop firms, thank God. When I started, we didn't, right? You were going to blow tens of thousands of dollars trading before you actually learn. So, yeah, a lot that goes into it, especially if you're trading multiple asset classes.
Definitely, yeah.
Yeah, but that's what I would say are the pros and cons of swing. If you're swinging options as well versus day trading.
No, perfect. I think now is the perfect time to go into the charts and look at some examples and take it from there.
Yeah, let's do that.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, TradeZeller. TradeZeller is the #1 trading tool in the entire trading industry. TradeZeller allows you to become a more profitable trader, allows you to make immense progress as a trader. Your to make on TradeZeller daily UCF20.
So now we're going to go into the actual charts and see prime examples of that context building and the universal playbook that we just went over.
Yes. All right. So let's start with the S&P 500 chart, right? And then I'll get into some of the trades that I've taken using these concepts. So the S&P 500 chart, and here's where I want to showcase to you that narrative and story is much more important than.
How do people all have this?
Strategy.
What is that shit? What's that?
Right? And we're going to tie in everything that we just talked about. So let's say that you have the S&P 500 chart here, right? And
How does he have this writing on his chart? I've seen like multiple people that have this. I don't get it.
Just remove the time frame. This is daily, but let's just remove the time frame out of the picture. Let's forget about that for a second, and let's remove fundamentals out of the picture, right? You have the S&P 500 here, and you have a trend line. Let's say that, again, this is a form of liquidity, and imagine that you took a long here, right? Would you be wrong in taking a long here? Now, you could say we did hit all-time high, and so what's beyond that is unknown. You wouldn't necessarily be wrong if you were bullish on the market. Whether you take a loss or not, again, as I say, it's not really the important part. What you're trying to do is achieve a disproportionate win versus the loss that you take with your stop limit. But you still want to build a narrative, right? But let's say that you whatever, either you took that long or you took an L on that long, right? This right here, when we talked about liquidity catalysts, that break of that trend line, if this is the first day that you see this chart, are you going to react? Are you going to feel like you might have to react soon? Yes. This is a liquidity event. We broke major support, right? This is after the election, after the beginning of the year, we broke major support. So can you
I mean, I don't care that much.
from here, right? We broke support, and remember, we want to see a retest. So let's say that you want to take a retest of that trend line. Where are you targeting? Don't we have this low right here?
Yeah.
Okay. You have that low right there. You have a low right here. You may be taking multiple contracts. You may be able to take partials there, take TP2 here. My point is, now you have a narrative. You have a liquidity event, you have a trend line, and you are going to play the retest of that trend line. What else do we have here? If you were a moving average trader, right? You have the 21 EMA right there as well. Let's say that your entry hit, you're targeting there. This is an example of having the complete picture. Now, again, I don't want to go into technicals, I don't want to go into fundamentals, but like I said, there is that seasonality surrounding the first year of an election cycle that you could have also used. Like if I knew that in the back of my mind, and I'll show you how to get better instantly at your fundamentals, but if I knew that in the back of my mind and I see this trade here, I might be more bearish biased, because can we sweep this liquidity and come back up and this be a swing failure or a fake out or stop hunt or whatever people call it? Yes, it can. You're not guaranteed that this is going to retest and drop. It can retest and come up, right? But if you also have the fundamental picture in your mind that we tend to see seasonal weakness in February after an election, that can help you with your story.
Oh, definitely. Yeah.
Now, if you are say you're not a trendline trader, right? And you are, I don't know, you trade SMC concepts or whatever, or you are looking for market structure shifts. In this, let me remove the EMA real quick, the 21 EMA. But in this series of higher highs and higher lows, you have a market structure shift right there. Right? This right here is an internal low. So what if the way that you traded took into account this drop below here, and you said to yourself, I'm going to take a trade at a retest of that level? You would still be right. This is why, it really boggles my mind. Actually, it annoys me when people get hung up on strategy. There are many ways to skin a cat, right? And again, you're looking at a liquidity event. I don't care if you trade trend lines, SMC. If you do it proficiently and manage your risk in a way where you're telling your story, you will have a decent win rate. And for sure, a decent R multiple, because you are taking disproportionately winning trades than you're losing ones, right? So this is an example of what I'm talking about. Now, I'm going to show you a trade that I've taken that I'm still in. I'm still in a QQQ long that I bought at 428.57 in April, right? This is still open to today. I took a screenshot right before here, June 6th. And that swing is in shares and it's currently still up 24%, right? So I'm going to walk you through my exact playbook of how I took that. Let me just delete all this stuff. All right. I bought it near this area here, right? And I bought it on QQQ, which is the NASDAQ and not S&P, only because, as I said before, NASDAQ moves disproportionately to the S&P 500. It's more tech heavy. So coming out of corrections, it tends to move higher. It has more violent moves, right? So whether you bought it in the S&P or the NASDAQ is fine. But here, I'm going to show you how I instantly improve my fundamentals if I know nothing about fundamentals, okay? If you remember, April 2nd was Liberation Day. This is where Trump announced the tariffs, right? So we had what I was showing to you on the board earlier. This right here was a 10% move, and we had a bounce from here, right? And it was also, Liberation Day, right? We tanked on Liberation Day, and we dropped to this level. Now, if you measure this here to the close, because in order to determine a bear market, the definition of a bear market is a 20% drop, not at the wick, at the close, right? So we did drop more than 20%, but we ended up closing 19.4%, right? So if you remember this, a lot of people, you said people in your life were asking you, but if you turned on CNBC or something, people thought the world was ending. The tariffs were way worse than people thought. Hundreds of percentage points on Vietnam and Cambodia and whoever, right? And it was seen as a potentially stagflationary event that would wreak havoc on the economy. So you were not wrong to think that we could have, fallen worse than this, right? But when you see this, again, what we were talking about earlier, a big move, is this a major liquidity level? So I pulled up the chart here, and the reason that I sent out this trade, and I'm still in it to this day, is because of this thought process. I'm looking at this and I took a look at something. Where did we drop? And I told you that I used a level from 3 years ago. This was the top of the bull market after COVID.
Yeah.
This was COVID. This was the top of the bull market, right?
Yep.
Okay, so we dropped to that level. Cool. Doesn't mean that we're gonna stop there. And by the way, I'm not trying to say that I'm Nostradamus and I knew the exact bottom of the market. I'm trying to say, do I have a story to take a trade and make money? That's it, right? Now, this right here was the 2022 bear market.
Yep.
What is this? This is the top of the 2020 bull market. Insane. So I was like, wait, is this a freaking trend? What is this? This was the bottom of the COVID lows. This right here was the all-time highs before the 2015. We didn't have a bear market, we had a correction. COVID stopped at the previous all-time highs before the correction, right? 2022 stopped at the 2020 highs before the COVID lows. And 2025 stopped at the 2021 highs. Insane. Now we talk about confluence, and I use fibs quite a bit, right? The bottom of the bear market to the top of the bull market, what is that? 0.5. The bottom of the bear market to the top of the bull market, 0.5. Now, how do we get better at fundamentals, right? Remember I told you this was a 19.4% drop?
Yeah.
If now I have this context, I have my fundamental confluence, I definitely have my technical this is wild to me. Bottom, top, bottom, top, bottom, top, right?
Ghost Pepper
You have your-
Salsa by Gavin Rye. What is that? Oh, it's like a restaurant or something. I don't think we have that in Canada. I don't think we have that in Canada. Maybe we do. No, we don't.
Fundamental confluence, you have your technical confluence. How do you not take a trade? Would you be more stupid to see this and not take it, or to see this and take it? You know what I mean?
Yeah.
So I ended up taking this in QQQ again, because I think NASDAQ is more, not I think, it is more, has bigger disproportionate moves to the upside after corrections and bear markets. So I ended up taking it in NASDAQ, and that trade is still open.
Red Ghost Pepper Hot Sauce.
Mind blowing.
It is, yeah. And it just shows you how, like, it doesn't have to be
I don't know if it was Ghost Pepper specifically, but I definitely went to some place that had wings here. My friend ordered like one of the plates with like the suicide whatever the hottest wings they had were. Yeah, I didn't like it. Not a fan of that stuff. Also, funnily enough, we had the same chart drawn for anyone that remembers the streams back then with the 0.5 level and all that. We had the same thing drawn at the time. Now we're eyeing the same thing again, right? This level right here, no joke. Right at the 382. Don't like spicy foods. Not spicy like that. Like when you're just like sitting there and like feel like shit and like sweating, like your throat's like burning. Not really. Not particularly enjoyable.
complex either. You know, you get to choose your style. And again, it shows not only from the sell-off perspective in the trade example we showed there, but then also the long and a more sort of more swing / position trade or investment, how it's still the same principles. You know, the principles don't change. But I definitely love obviously the example of fundamental side of things. You know, being able to get data written up for you, very quick, easy reading. You know, it has. These are one of the prime examples of how innovation and technology changes the landscape for retail traders. You know, because even if you want to spend the thousands, even that data is not collected and
When
put
it's
into a format
different.
that is necessarily easy to read, or at least personable, right? And versus obviously using Grok or ChatGPT, where you can request for the information in particular different styles or ways that would make sense to you, or allow you to resonate with it. So you have all this freedom and all these tools that are available now that were never available
Plus, you also don't
before.
feel good
And so
afterwards. You
therefore
go to the bathroom and
excuses-
whatnot.
So hopefully we'll get more limited,
Because I don't.
excuses that are possible, but it does boil down to just at the end of the day, making sure to use the tools necessary and to be able to take action on the things that you know are going to help you progress as a trader.
100%. Yeah. And I think that, that's why it gets in, and I'm sure you experience this too, but being on social media, being in the trading space, when people start asking you questions like, oh, what does this mean?
Are you
Type
thinking
that
about
exact
wings?
question here. And then
Yeah, I'm
learn.
hungry too.
The only way to get better at fundamentals is to start building a knowledge base, right? And to those people that say, fundamentals don't matter when you're day trading. No, they do. Try day trading FOMC. Try day trading a jobs report. If you don't know that stuff is there, you're not going to understand why there will be wicks, why you're going to get stopped out. As a matter of fact, one of the best ways to trade fundamentals while day trading is to wait for the fundamental news to drop. Look for the manipulation and then trade the other side to the next area of liquidity.
Yeah, because that's what you'll find with a lot of fundamental news is that it will spike or drive into a key level, into a higher level, higher time frame sort of a liquidity sweep. And then that's why a lot of the time you'll see that reaction away. If that hasn't happened and it does end up pushing in one direction and continuing that direction, what is usually the case is that liquidity was taken before the news. So therefore, it then sets up for the news to be able to then drive in the opposite way. But either way, if you look at, and again, this is something that you can quite simply just go on the chart, look at the days that these news releases are taking place. If it makes it easier for you, you're using the exact method you've shown, you can type in what were the dates of the last 10 NFPs, right?
Exactly. Yeah.
And then go to those dates and be able to essentially backtest or at least just observe the story. And I think if you go back to that context that we started with, that's essentially the exercise you can begin with. Rather than trying to do it live, your beginning exercise can literally be, whether it's using the fundamental side of things or just going back to particular dates and starting with the framework of what was the story on this day based on what was yesterday's closure like, what areas of interest or liquidity areas are nearby, and then building your story in context and then letting it play out and just kind of training yourself to be thinking in that way. Because it is a simple way as well. That's the beauty of it. It's not like you're training yourself to read a whole new language. You take even the most novice and basic and beginner trader who knows the basics can implement
Yeah,
that.
is it me or have they not talked about like an actual trading strategy the whole time? Basically, all he did was I bought the dip on the crash. That's the TLDR of his 60-minute video so far.
Thought process and that process of looking and observing the charts in terms of building that context from day one. And it's a much more powerful technique because it's going to
Not
allow you
anything
to
useful.
really have an understanding, regardless of strategy.
Yeah, not
and where
really.
you be-
I've
where
made
you
like
should
0
be
notes for this
positioning and
video
where you
so
shouldn't be.
far.
And most of all, even if you miss a trade, even if you lose a trade, because that's all of those things are going to happen, at least you know you did it from a perspective of planning your trade out, having context behind your trade. And therefore, if you're wrong, it's, I would imagine, harder to be annoyed at yourself or to be as emotional because you know you built a context and story around your trade. And a lot of the time, if you are wrong, it's normally because potentially you missed a step, didn't observe something that would have added that context and that sort of story for you to understand. And a lot of the time, it's just being able to go back and review that. Right. And again, it's not a case where you're trying to strive for perfection, where you get to a point where 100% of your trades are winners. It's just allowing yourself to consistently learn and sort of learn from mistakes or learn from things that didn't work out, so that the next your ability to create context in the story improves over time.
For sure. Yeah. I mean, and that's why like the way that I approach trading with the universal playbook is, to me, it is, it's the best way to approach the charts, because like you said, you're not aiming for perfection. So I'll share with you a trade that I took a loss on, right? And you could see immediately how this trade can be misinterpreted, right? So on the S&P 500, and remember that 10% drop that I told you about, how the S&P tends to react from these 10% drops. Here's the 10% drop, and we got a reaction, right? Now, we didn't know Liberation Day was coming here. We knew it was coming. We didn't know what it was going to be, right? If you looked at this and you see these equal lows right here. Oops. What the hell? My bad. You see these equal lows right here. We breach below it. This looks like a liquidity sweep, right? And we pop back above it. And
That
now
is not a
retest again.
liquidity
This is
sweep.
a major level, clearly.
That spending 3 days below. That is not a liquidity sweep. This guy is fucking cooked. How many candles did it spend below? 1, 2, 3, 4, 5, Just spent over a week below the level. That is not a liquidity sweep.
You have a high, a low, a low. It's a clear support and resistance level. If you said to yourself that I'm going to long from here,
Yeah.
which I did long from here, right? You would have got stopped out on this trade. But guess what? I had a story, a narrative that made sense, a framework, and I don't really care that this stopped me out, because what am I doing now, right? The next thing I'm doing is saying, oh shit, that didn't work out. Maybe what's going on is this trend line here, which some people will call a bear flag. I don't care what strategy you use. These are all the same concepts. This is a bear flag right here.
Yeah.
Right?
Mm-hmm.
I missed the long from here, and now I'm looking at a bear flag, and I'm like, oh, maybe the trade is actually a breach of this, and now I'm going to wait for a retest of the bear flag, and I think we are now targeting these equal lows here. So I do have another trade, I do have another story, and what's really one of the pros that I talked about swing trading is you have a lot more time, right? And the other thing is that I didn't write, that I should have, you are less prone to revenge. I cannot revenge trade if I'm looking at, and I'm not saying swing trading is better than day trading. I'm just saying one of the pros and cons. I cannot revenge trade if I'm swing trading. I can't like miss that trade and then immediately enter one, because these candles need days to play out, right? So when you're day trading, it is so much easier to get caught up in, oh shit, I got to enter again. You can fake yourself out. You can enrage yourself into continuing to enter trades, right? That's why I think beginners should really be paper trading, trade with a prop firm. Do not waste your own capital trying to day trade, especially derivatives like futures or options. These things can maximize your losses and really get you into a cycle that your brain isn't used to working with yet. You know what I mean? So yeah, that is definitely one of the pros and cons that I didn't talk about, is that swing trading, you're much less prone to revenge trading, and you can easily see where you were wrong, and then the next couple of days, set up another trade, tell another story, work within that, set up your risk within the pages of that story.
Well, I think again, to your point, because even traders who are, say, not as novices, but they're not still utilizing really that concept of a story, and even on a swing trading perspective, I think that missing gap of not having context or a story that they're working off, and a lot of the time maybe just using patterns or just how they feel or however they're operating, but missing that context, is even when they're meant to be swing trading, they will still make that mistake of, say, getting stopped out and then entering. Again, because they're not working or operating off a story. They're operating off, this is what I think, maybe using certain technical complements or strategy. And when they lose, even on a swing trading perspective, they just end up falling into that trap of, oh, let me get back in because it's going to go my way. Maybe it was a fake out, etc., etc. When you have that story and context, when you're wrong, it allows you to, hopefully, you're going to repeat the process, right?
I mean, that's debatable, right? That's
training
definitely debatable.
your trade.
That is definitely debatable. Like, you can definitely, I mean, in the ideal world, you don't have to deal with the situation, but you can be in a world where you have like the right trade idea and you're just a little too early on your entry. So like you're trading the daily chart and you drill down into the lower time frame to try and find an entry. And like you get stopped out on your first or second attempt. Like tiny losses comparatively. But then like when the third one starts running, it like covers all your losses and then some. But ideally, you're not just FOMOing in randomly though. It's like if you missed like the first high quality setup, then you take the next high quality setup. You don't just try and get back in immediately after getting stopped out for no reason.
Great ideas is to go back then to your context and story. Like, what is that now? Has that changed? Which 9 times out of 10, especially from a swing trading perspective, rebuttal from people will always be like, why wouldn't you just take those trades? But confidence within your trade, time frame high
trades. So they look like trades. You might have a fair value gap. You might have.
Fuck, where were we? Just rewind this for a second. 104.
And being able to go through some of these repetitions, then that's what the process should be. Then you create your new context based on the new information that's been provided, both from a technical standpoint in this example, but also the fundamental perspective as well, based on the tariffs for this one, and then execute accordingly, right? And that's why I think, yeah, like the universal playbook is a great name for it, because it is truly that framework of building context around your trade ideas is necessary. I think
I
regardless
don't know
of
if this is universal framework, right? Like, are people really sitting here trading like a trend line on like the 5-second chart? I don't know about that.
like what type of trader you are, what you trade. Without that, if you're going to be just using just a technical edge, for example, or just a technical strategy, you are missing out on a lot of information, and I would say even the psychological aspect as well. Because by having that context story, it allows you to build confidence within your trade, because you've put together this thesis based on multiple information, right? Multiple information from the technical, fundamental perspective, everything, rather than, as we say, just using technicals by itself and not really creating any context. More so just like, especially in the sort of SMC ICT world, it's very easy for people to, even if they have a swing trading strategy in mind, of that's where their thesis begins, find themselves just getting sucked into lower time frames, marking out any sort of lower time frame high and low, and removing all context, removing all sort of story, and really acting off emotion and probably the need to try and win a trade.
For sure, yeah. I think that also with day trading, especially if you're using a model like SMC, or any model for that matter, you are much more prone to take what I call lookalike trades. So they look like trades. You might have a fair value gap. You might have what you think is a market structure shift, but without the context of high time frame, doesn't make sense for price to go there based on the hourly candle. Doesn't make sense for price to go there based on the 4-hour candle. You are still building a story, and it is a much more, like I said, complex, quick. Fight or flight is involved, panic is involved, immediate feedback is involved. You don't have time to sit there and think about your plan for the trade, right? And you're more prone to revenge trading. But yes, for sure, I think that people go to the lower time frames because it's a time frame that offers the most would-be entries.
Yeah.
Right? Yeah. And they cannot stop themselves from sitting on their hands until their story develops. Now, your mind has to work a lot faster. Like the way that I broke down, again, I was using the daily for a reductive sense. Obviously, I use weekly, 4-hour, 1 hour, and I start building my story around other confluences on other timeframes as well. I'm not just a daily chart trader. But imagine what I did here. Imagine I had a few seconds to do that. That is what day trading is like. And I don't think that people really understand how much time it takes to get in the right mind frame, to understand that you need to build a story even on the lower time frame, and you have to stop it. Moreover,
Well, you gotta be prepared, right? So you gotta be prepared. You gotta have all your levels in mind beforehand. That way, when the market opens, you just know you're waiting for price to get here and what you're gonna be looking for when it does get there. But yeah, if you're just kind of winging it on the lower time frame, it's gonna be pretty overwhelming.
Which, when you are swing trading, there is a lot more deliberate performance that it's just baked in. I cannot enter 1 million swing trades a day because these candles move very slowly. If this was a 1-minute chart, I can enter 15 times in the same hour. You know what I mean?
Mm-hmm. No, so true. And I think, a big part of that as well is, if you are going the day trading route, which is no problem with, it's understanding that there will be a process of training yourself to be able to react and take in information. First of all, take in information quickly, decipher that information, build your context, and then react accordingly, which, as you say, for example, a trade idea on that time frame, you might be coming in with a particular context and bias, but as the relevant information is then taking place, maybe a market structure shift or some sort of liquidity sweep is taking place, and that reaction is taking place in the real time within a few minutes, you're then having to take that information, make sure it's aligned with your context that you've hopefully pre-planned if you're doing it the right way, and then be able to execute and manage and plan your trade in terms of your stop loss, your take profit, etc., within those few minutes, which is no problem. But again, giving yourself the time to build your level of skill set and your ability to decipher information in a fast manner, rather than just jumping into it. I think a lot of people, they jump into it without sort of having any sort of practice, building any sort of reps, training themselves to be able to think and act in a faster manner. And therefore, sometimes it might work out, and they're the times that reinforce them to do it again in the future.
Right.
But a lot of the time it won't work out. But again, they won't understand why, right? Because they haven't allowed themselves the time to build up that skill set, if you will, of speed and being able to decipher information at speed. When, again, the daily time frame, the interesting thing is you look at the daily time frame, and we've just done examples on that, and you get, oh, that's easy, right? But then as soon as most people don't really have the discipline to stick to just one time frame of trading, for example, so they start to go lower, of course. But then things change. The actual patterns stay the same, the concepts stay the same, the context stays the same in that sense. But the one, obviously, now you're adding layers to your trade. So now, let's say your 1 hour, you need to remember your context from your 4-hour and your daily. So you're adding layers to your story. Mm-hmm. And then obviously on that time frame that you're actually executing on, you have to then be able to decipher all that information. So it's an interesting task. And, I think there are pros and cons, of course, to each one in terms of like day trading versus swing trading. And people can easily make arguments for which one's better or worse. But it's more so just making sure to understand, as long as you planned your trade according, so if you've planned a
Where
swing
did
trade,
this
you
video
shouldn't
go
then be
off
day
the
trading
rails?
that plan, right? Or vice versa.
Yeah, I mean, honestly, this is what gets me about watching financial news like CNBC. If you watch like CNBC, um, it's so funny because they talk about events that happen today with such fervor and panic, but most of their customer base are older people that have retirement funds, and so it's like I always find it funny. It really reinforces bad habits that most of their customer base are long-term investors, but the way they talk about the markets is what's happening today. Well, are interest rates going to go to 15%? Are we screwed? Is it? And I'm just like, who is this for? You know what I mean? Yeah. But yeah, you're 100% right. But I mean, like, yeah, even here, if you look at the NASDAQ chart, right, there's so many fair value gaps, and now IFVGs, people are really into IFVGs, which is great. But I think people turn into pattern traders, meaning they're just looking at an IFVG or an FVG and thinking that every single one means something. Most of them mean nothing. Most of them mean nothing because you have to align yourself with the high time frame, right? Like right now on the hourly chart on NASDAQ, this is an hourly fair value gap. Does it make sense for price to be moving up? Yes, it makes sense for price to be moving up. But if I'm on the lower time frame and I might see a fair value gap, I know kind of what a fair value gap is. I know what a lookalike trade is, and I might want to enter short from here just because there's a bearish fair value gap right there. You know what I mean? But if you look at the hourly, are you moving along with hourly flow at the moment? And I think that context is missing. And again, it goes back to building a story. And it's just very hard to do if you don't know how to build a story and you were trying to come into day trading without your mind being trained to think of things as a story. You are just trying to enter these false signals time and time again, and you're going to blow your account that way.
Mm-hmm. And that's what it goes back to, right? To spend the time necessary to just develop your eyes and develop your ability and skill set of building that context. And the truth is, it doesn't take that long, but it's just making sure to put it in. And going back to your original analogy, that is the difference between your basketball players, elite professional sports players and poker players and traders, is that they have done enough iterations and reps in training so that when it's game time, even then, as you said with the basketball examples, like even game time, the strike rate, if you will, and the performance rate is still an average. It's not like 100% or 80%, but they're still only able to do that because they put in those reps in training.
That's it, and they understand the variance. So because I'm a data guy, like one of these stats that I really love is, say your win rate is 50%, right? Even if you're a 2R trader and your win rate's 50%, you're profitable. But within the span of 100 random trades, what do you think is the probability that you lose 5 trades in a row in the span of 100 trades?
With 50% win rate? Pretty high, right? Pretty high. I know for a 7, it's like 30-something%.
I would say it's quite high, yeah.
95% probability that at one point within a 100 trade sequence, you will lose 5 trades in a row. 4 trades in a row, it's 100%.
Really?
100% statistical probability you will lose 4 trades in a row. Now, if you are a seasoned trader and you're just trading your model every single time and you have your stats to back it up and you are a 50% 2R trader, right? You're not really going to bat an eye at that. It might make you feel bad by the 4th one. It would probably make me feel bad by the 4th one. I'm like, there's something going on here.
Yeah.
But you've done it enough times and you understand variance. Whereas someone who isn't seasoned doesn't have that context, doesn't have the mental training, doesn't have the ability to tell their story, doesn't know, not confident in their framework. 5 trades in a row would demolish somebody who doesn't have.
They'll question everything and then move on to the next strategy. They blame that rather than understanding that it's understanding statistics that it is a very high probability. Because even then, I bet the number for 10 trades in a row is probably higher than what people assume. And especially if you're doing it over, rather than 100 trades, doing it over 1,000, right? Because I always say to people,
no, it definitely goes down a lot.
What's the reality of you?
Like, I don't know about like 10, like if you're taking 100 trades, the probability of like the streak is it goes like this, right? The more losses you're trying to like consider in a row within the 100 trades.
Having a losing month or quarter.
What's the depends on the win rate?
10-year trading career, right? Or 20-year trading career. What's the chances of that? The chances are quite high. You're going to have one at least, right?
Yeah, I've had a losing year, yes. And most people will not, you can't say that if you're trying to build a perfect image on X, right?
Exactly, yeah. And then the reality of facing that, because one thing saying it, but then the reality of, okay, as a trader, especially if you've been consistent, say for 6 years, and then you have a losing year, the toll on the psychology to make sure you continue and stay on process and still do all the right principles to make sure that you stay on track because you know you did everything right. Yeah, there might have been some learning things and some mistakes within that year, of course, but regardless, that's where, you know, one of those moments where it's like you're either going to make it or you're going to end up going backwards, right? Because a lot of traders will probably have that, even if it's not as dire as having a losing year. Even if it's, let's say, year 1 was 100k, year 2 was 250, year 3 was 500, and then for some reason year 5 was 100k again. But you're still profitable. But you've gone, essentially in your head, you've said you've gone backwards.
Yeah.
Again, these moments are really where the true test for traders comes in. A lot of traders won't actually get there, unfortunately, right? Because they won't actually put in these foundational things we talked about today.
They won't. Yeah, they won't. And I think another thing that people misunderstand, not you, because you talk to a lot of seasoned traders, but a lot of times, especially when it comes to positional trades, like swing trades, where you're trading your own capital, I'm not talking about prop right now, really throughout the year, you will remember the 2-3 trades that have made your year.
Yeah.
You will remember that, right? Like, yeah, sure, you know enough, like you are seasoned enough not.
The gambler's fallacy, also known as the Mark Hall fantasy, is incorrect belief that the outcome of certain random events thus was more likely to occur based on previous independent results. Yeah, but it's not as simple as saying that either, right? You have to account for like set theory. Like the probability of having, like, let's say you have like a 70% win rate. So like your loss rate is 0.3. The probability of having like 5 in a row is what? Quite low. But then like if you like raise the exponent more, it gets like even less and less.
Not to get yourself in trouble. You maybe are having winning month after winning month, and they're probably modest by your standards, or you know they may be more than average.
So like,
but
yeah,
then you
like
have that
the
one trade that-
individual measuring the next individual event is irrelevant of the previous one, but when you like measure as a set, it's a little different. The probability of having like consecutive losses more, like, just continually growing, is it getting less and less?
comes around where the fundamentals and the technicals meet, and you know, like Liberation Day, for instance, or yesterday. I know a lot of people that traded Tesla yesterday, right, because of the spat between Elon and Trump. After it broke below a major level and retested that level, there was a huge drop thereafter, right? I think it was down like 5%, and by the end of the day, it was almost 15%. So, you know, those types of trades, you'll have a few of them, and they will make your year. And I don't think that I think people don't understand that people that are new don't understand that concept.
Yeah.
And they want to be profitable, super profitable on every trade immediately, so they oversize.
Yeah.
You know what I mean? But yeah, even for seasoned traders, really 2-3 trades make up your entire year of a good year.
No, so true. We've seen this now as a common theme since, you know, doing our tour and sort of interviewing professional traders and verified traders. That's the common theme, you know, when it comes to dynamic risk sizing, but then also understanding that, yeah, a small number of tickers or stock or pairs or whatever you want to call it is going to make up most of your year and most of your P&L, and then a small number of trades will also make up the most of your P&L. And then the argument or the rebuttal from people would always be like, why wouldn't you just take those trades? But then it's like, well, if let's say it's like ring rust, right? If I'm a fighter and I'm out of the ring for a year, I wait only for the McGregor fight, right? The big fight. By the time I get in there, I'm going to be so rusty and I'm not going to perform well. I'm probably going to lose that fight. And you haven't given yourself any edge or sharpness. And also, you know, really importantly, that's really where you get that dynamic size from, because you then have the house money from the base hits. So the majority of trades that then make up maybe a smaller part of your P&L, but because of that, they allowed you to then have the capital necessary to increase risk on that trade that comes along. You know, like the beauty is, and we can finish up with this, but like,
Sure.
you know, to your point, they happen few and far between. But I think that is why a lot of traders are so excited to have Trump in office, because he essentially is manufacturing more of these moments. Like usually you, as you say, get maybe 2 a year on average. Like when Biden was in, probably you got way less, right? But when Trump's in, you end up having, you know, we're almost 6 months into the year, and we probably already had 3 or 4, right? Which isn't normally the case. So that's why, like, the, you know, professional traders and traders like yourself are actually very much tuned in, knowing that there's going to be more opportunity available to a seasoned, well-prepared trader. So to be able to take advantage, because it's in these moments that might not happen again in our lifetime, where you get someone who comes into office who's providing these sort of liquidity events and these sort of volatility within the markets to present these opportunities. And really, our job isn't to say try and capture every single one. All you need is one, really. Yeah, and if you manage to get 2 or 3, then incredible, right? And I think again, yeah, it goes back to what we said. Like the traders were constantly trying to be perfect and get every single move and 100% strike rates. It's just not the reality of actual trading. But regardless, though, universal playbook, incredible, and it's universal not only across different asset classes or time frames, but it's universal in terms of it will never change either. In my opinion, like 100 years from now, whatever the markets look like, whatever technologies come in, it's the same context and story that will be needed to trade. And if anything, people might talk about algorithms, for example. That's the same thing. The algorithms need context and stories, and so if and then statements to be able to operate and transact.
They're based on if then statements. Yeah.
Exactly. Well, Z, I really appreciate you breaking down this model for us today. And everyone at home, drop a comment with your biggest take.
And, I thought this guy was gonna go on a whole tangent of like when he mentioned like first of all, he never really mentioned what the divergence was. Secondly, where's the whiteboard? Probability of having at least one run of 4 consecutive heads and 100 coin crosses. Yeah, isn't that what they said in the video? Like, yeah, he said that he looks for confluence, like technical confluence. Then he like mentioned the first thing that was divergence, and he never mentioned one again. Yeah, I mean that is basically 100%. The guy's off by like 100 millionth of a percentage point or something.
Is a record breaker and one of the most successful prop firm traders in the world, making over $700,000 in a single payout.
I have this plan, and I know if I stick to this plan over the long run, I'll make money. My backtest data suggested it's been true for the last couple of years, so I'm just going to stick to that plan regardless of anything, because I know if I just do this and nothing else, I'll be fine in the long run.
Introducing Matej, starting from nothing as a teenager.
1 in a 200 million chance of not getting 4 heads in a row.
He's managed to make a name for himself as one of the most prolific prop firm traders in the online space, making over $1 million in verified payouts in a very short amount of time. In this episode, Matej strategizes how to pick and navigate prop firms and how he structures and sequences multiple accounts and navigate risk and the rules so that the accounts work for him, not the prop firm rules against him.
Everything can work. These broke ICT traders, they are so set on their best practices and on their specific rules that they completely neglect the fundamentals that actually made these rules or these best practices in the first place. So for example, about how can I be able to stick to my plan better? Which book should I read? Which breathing technique should I use? This is just something you got to do. It's the same as trying to get abs by reading about getting abs. You have to go to the gym, you have to do the plank for longer than you want, you have to skip on the burger and eat the salad. It's very obvious that the suffering isn't optional, you just got to do it. In trading, people still seem to think that once I read this book or once I did this meditation or whatever, then it won't be hard anymore, but it always is hard. You just get better at doing it.
You've been around the prop firm era since the beginning, but also you've been able to exploit them and make the most out of it as well. Do you think it's important to have a strategy for like a personal account and trade it the same for prop firms, or should there be a way you trade prop firms in a specific way when it comes to risk or
Palladium's really
technicals or
going,
maybe shorter time horizons? Is there a specific way you traded with prop firms?
Yeah, I think there definitely should be a difference. If you look at the...
Matej, thank you for joining us today, man. And it's quite a phenomenal career you've had in a short amount of time. I know you've been hustling since you were 16, 17, but the success you've had in a short amount of time is something worth exploring. And one thing to note is how much has changed in the last...
Everyone in the US flipped a coin 100 times. People would never... Everyone in the US flipped a coin 100 times. 2 people would never have 4 or more heads in a row. I have to get food. Hungry. Someone should name a dish. An odd name for a drink.
2 years where your net payouts maybe just a year or so ago was several six figures, and now you've crossed 7 figures. And I'm sure it comes with a lot of feelings, euphoria, pride, sense of achievement. And you wrote a tweet at the day you got the payout, which was $713,465 in a single payout. So I wanted to read this to you because I'm sure it captures the feeling in the moment, and then we can reflect on it. So you're saying this is the biggest payout of my life, a truly life-changing amount. I'm sure plenty of people have seen the massive payouts, but they haven't seen the complete obsession over the last 5 years. And this is the part I want to focus on. For the last 5 years, I haven't taken a proper day off. I made no distinction between work days and weekends, holidays for that matter. Whenever, wherever, trading was all I could think about. So speaking about the high and the win, I guess there's not a lesson in there, but in the journey there is. So speak to me about this obsession and this journey you had, especially when you're at a young age, 19, 20 years old at the time.
Yeah. I was just completely obsessed by it. So I started trading when I was 17, 18. I immediately fell in love with it, and I knew this is what I want to be great at. I also always had the urge to be great at something. So fun little backstory is I used to box a lot, and I really enjoyed it. But at a certain point of time, I started when I was 16, 17, and it just really hit me that I would never be able to be truly great at it, because these kids that I've been training since they were 5, they have like 10,000 hours on me. I probably wouldn't be able to make that up. But in trading, I am the kid that started at 5, to say. So when you start at 16, 17, complete obsession, then it is possible to actually become very great at it. So that's one of the reasons I was able to really sink my teeth into it. I also obviously wanted the money, but I think trading is I'm an obsessive person, and trading is very easy to obsess about. And I think that's because it has similar mechanics to the gambling kind of thing. So maybe it was just a gambling addiction hiding as an obsession.
It's a fine line, to be honest.
Yeah, it is. But yeah, I just wanted to make this succeed at whatever cost. It was incredibly important to me. So I did, and I didn't care that much about what it cost. So whether it was my relationships, I lost a bunch of friends. I didn't go out. I didn't take weekends. I didn't take vacations. When I went on vacation, because my mom pushed me, then it was still my laptop with me. I was, working on the plane, in the car, working at the pool. It was all I could think about all day, every day. And it's not just about when the
As a
when you
grinder,
have the laptop with you. It's also just when you're walking the dog and you're playing these trades in your head. You're thinking about the prop firm game. You're thinking about all these things. When you're at dinner, you're constantly, and that's what I think. People that haven't had it, they probably don't really understand it.
probably
Just
not.
like it was the only thing on my mind. There was nothing else playing. It was pure obsession. This was all I thought about. The moment I woke up till the moment I went to bed, it was charts in my head. It was charts in my dreams. It's
So the way you're describing it now, let's not talk about today where you have 7 figures in payouts, but this obsession that you have, this hyperfixation, this desire to make it work out, but no results. So year 1, 2, or 3. What is that? Does it feel like a burden? The way you're describing it, like now you can say, this is my job, this is what's working for me, and I'm obsessed with it because it's working. But obsession without results can also be insanity in a way.
Yeah, it's Mr. Beast or whoever that said it. Like, they call you crazy until it works, then they call you genius. I think that captures it pretty well. First years are incredibly rough, and that's also why I did take a little break after my second year, because after my first 1 year and a half, I still hadn't made any money. In fact, I lost money, so I ran a website business on the side to fund my trading thing. So I sold websites, then I used the money to trade, usually lost it. Then I sold another website, traded, lost it. And at a certain point, so after about 1 year and a half, it really just hit me that if I just spent all this time, all this obsession doing the website business, I'd be what I then considered rich by now, right? If I put in all that effort, all that time into websites, I would have had something to show for it. I was sure of it, whilst I didn't after year 2. So I took a break for a couple months, I think 5 or 6 months. I completely stopped trading. I focused on the website business, and that actually took off pretty nicely. And then when I got back to trading, I was able to also approach it with a different mindset, with more money, with more. The first year and a half, I was constantly trying to make up the losses, and that's the approach that I had. I was just, if I can just hit this trade, then maybe I'll be back at break even, then maybe I'll have something to show for it. And I think the break really helped me in the sense that it completely reset the mental strain. I also came back with money to lose, which is nice to have when you're trading.
This is something that I figured would be important. So a segment that I wanted to take today was, mastering prop firms. So we can jump into this because you've been around the prop firm era since the beginning, and obviously now things are more clear for the general participant, but back then they weren't. But also you've been able to exploit them and make the most out of it as well. Let's start off with the beginning process of working with prop firms. Do you think it's important to have a strategy for like a personal account and trade it the same for prop firms, or should there be a way you trade prop firms in a specific way when it comes to risk or technicals or maybe shorter time horizons? Is there a specific way you traded with prop firms?
Yeah, I think there definitely should be a difference. If you look at the best strategy for 99% of traders is just to buy S&P and hold it, buy indices and hold it. That's the best strategy on personal account. But on a prop firm account, that would never work, right? So the best strategy for most people on a personal would never work on prop firms, and I think it goes.
That's not trading though.
The other way around as well. So I definitely think that's an underrated aspect of trading prop firms, and I think they should be treated more like a different style of trading, different kind of financial instrument. I like to compare it to option trading, and that you wouldn't use the same strategy for option trading as you would for regular trading, because you need to know more when you're trading options. You need to not just know the price will go up or go down. You need to know when it will and by how much. And I think it's pretty similar in the prop firm game. Is you need to know the asset you're trading, but you also need to know how this prop firm works and how you can get the most payouts for your spend. A simple example is, for example, if you buy 10 10K accounts or one 100K account, and you take the exact same trades, let's say you're able to make 1% on the funded account before you blow it. On a 100K account, you pay around $500, you make $1,000 in payout, so you make $500 in profit, right? But if you had bought 10 $10,000 accounts, those usually cost $100, so you'd have spent $1,000, you'd made $1,000 back, so you'd be at break even. So it's the exact same trades, the exact same edge, but the way you apply it to prop firms makes a massive difference in the profit you get in the end. And I think there's a lot of ways like that, and I think it has a bad rap, or worse rap than it should be, because there's a lot of reverse arbitrage and there's a lot of cheating going around, but you still should be smart about how you trade prop firms. You still should try to optimize the payout to spend ratio regardless of.
Do you think it's just a game of chance where, let's say you have a very large budget with prop firms and you have a ordinary, even if you're a break-even trader, as you're implying here, you don't need to have a massive equity curve. You just need to capture the payout to pay-in ratio. And even if you blow the account, you can just buy some more. Do you think the goal is always have a budget and then with your payouts reinvest until eventually you hit it big and maybe you get one massive payout? Or is it more about trying to get 1% and just lock it in and just do that month after month?
It's whatever works for you, I'd say. I'm very big into data, so whatever your backtest suggests, whatever your trading plan suggests you should do, I think you should just do that. I think both strategies work, and when I started trading, I always went for 1% payout, so quite different than the things people know me now for, I guess, because now I obviously do have the money to not really care about blowing account, but back when I started, I always aimed for a 1% payout, so I think that worked fine for me. I don't think one is necessarily better than the other. It's whatever works for you.
Let's take a moment to talk about a partner of the show, a leading prop firm that is Funded Next. It's important for me to only build 700 mark subscription or use the code TOT. When you were starting off with prop firms, and let's say you were at the 100K mark, I guess it was this approach of smaller payouts and just lock them in and try and get consistency. But then what led to your financial success was a big payout. Was that the same approach specifically for this 700K payout?
It's the same trading strategy, it's just bigger numbers, right?
From a risk perspective, or you just allowed it to accumulate and then took a payout in one go?
Yeah, both. So yeah, when I started trading, I risked very little. I was very conservative in those things. Also because I didn't have the money, I had to be careful. I had these 2 accounts, and if I blew one of them, then I was screwed. Then there would be pressure on. But now it's different. I can just go again, and it doesn't have to be profitable right now. I can take the losses for a while, and I can stomach those whilst in the beginning obviously you can't. But I think it's very much the same thing. Just the Apex payouts, I just immediately went big. I wanted to get this big payout, I tried for it. And
Is it out of sync
So,
or is
yeah,
it just
it's
me?
in that way, to get this big payout, I tried for it. Payouts, I just immediately went big. I wanted to
Out of
get this
sync.
big payout, I tried for it.
Throwing me
And-
off.
So yeah, it's different in that way. My goal was at first to get $1 million in payout. So $1 million in a single payout. That was the initial goal. But as I was building up there, I got too stressed. It was too stressful for me to manage. So I just said 700,000 is fine. I'll take it. And
The stress being that you don't want to lose the 700k you're floating just to gain another 300.
yeah, so yeah, it was weighing on my mental. So the biggest account was $270,000. I used to risk, I think, like 20%.
Oh,
Yeah,
okay.
so that's 50,000 USD, and that's stressful. But I only risked it on one account, right? So I had 6 accounts, 6 big ones, and whichever I traded, I used to risk 20% of that one.
Okay.
So in the entire portfolio, that's about 4%. That's
I see
not
your
too
point.
crazy.
Okay.
But the numbers just got so big for me that I got uncomfortable. I was scared that I wasn't going to, that if it got bigger, that I'd do stupid stuff. So I just
Yes.
locked it in.
It's interesting because the word you're probably battling with is greed on one side and fear of loss on the other
Yeah.
side. And in a sensible way, you were like, okay, let's make a decision to lock this in because it's a huge amount of money, and the extra 300k could just be for the tick. I did the million in a payout, but
Yeah.
for the spending power, the 700k is more than enough. Let's say
Mm.
when you have that position where others would have just said, YOLO trade, let me just get that million, and maybe lost the whole thing, or maybe had a lucky payout. Who knows?
Yeah.
It could go either way. How were you able to stay calm? Or what conversation did you have with yourself?
So for me, really, originally the goal
Short jeans and old gym shoes. That's what everyone wears. If you were to go to like Silicon Valley and you see some like CEO of some tech company walking around, you wouldn't even know it.
was the $1 million, so that's what I set my mind to. But as I started,
Okay, let me brush my teeth while we wait for this gap to fill. Well, I mean, it basically did fill it actually. The alarm never went off. Close enough. Close fucking enough. At least it would be fitted clothes and untorn shoes.
trading, I realized, I started noticing myself, I started feeling
But he's not even wearing
this-
anything that weird.
just a hormonal imbalance
Fif-
pretty much. I started, the numbers
15:30.
just got so big for me.
Yeah, I just got jeans and they're not even like, these are regular Jordans. They're not even, it's not like they're like fucked up or something. Well, it's just clothes, doesn't matter. I'm sitting here wearing pajamas like 100% of the time. There are times when I wear this out to the grocery store. Mac's girlfriend will be pissed. Be like, you mad? Are you fucking mad or no? Or no? Not doing an interview. If I was, I probably would do the same thing. Don't give a fuck. Fuck. Oh, what do they say? Right? When you walk into a room full of executives and there's like 20 people wearing a suit and there's just one person in the back of the room just wearing fucking whatever. That's who runs the show, right?
This just a hormonal imbalance, pretty much. I started feeling stressed. I started feeling the clouded judgment. I knew I wasn't on my A game anymore, and I wasn't willing to trade $700,000 on my B game. So that's why I called it quits. And I think trading and business, but trading especially, just takes a lot of introspection. I think that's a very underrated skill or ability or whatever you want to call it. But I think what I was able to do that some maybe wouldn't was recognizing myself. This is getting too much, and just call it there. Whilst most people maybe wouldn't have been able to recognize it in themselves, or who would have thought they could handle it better than they actually could, start taking bad trades, and that's where it goes bad.
When you locked in the 700K and I guess your net worth just jumped, aside from the feeling of what everyone can probably imagine it was like, what was the play after that? Because you can now say, okay, I've got a huge budget, let's turn this into like a snowball and we get like 3 million in payouts. Or you could be like, let me just put it in S&P, as you were saying, and I can just get 70K a year for the rest of my life. That's a good salary at 10% yield. Or you could say, let me put it into a personal account. What kind of decisions did you make with such a large payout? Because I imagine the goal is to keep growing it financially.
Yes, it is. To be honest, I haven't really decided yet. I think scaling further in prop firms is quite difficult. Because there comes a certain point where you have to be as much of an internet marketer as a prop trader to get these payouts.
What do you mean by that?
So the prop firms, they do the B-book model. So Apex lost their money when I made it with them. Prop firms lose the money that I made with them. And most firms, they are not willing to just keep on losing that much money on you. So with most, you get, when you're really profitable, you get an eval ban or whatever.
Or a risk limitation.
I've had plenty of firms come up to me, and most of them are even like pretty honest about it. They just tell me, you're making too much. You either you can't buy any more challenges. If you want to, we can give you this real account. But then usually the balances are so small that it's not worth my time. That's like $20,000-$30,000 accounts, which obviously isn't bad. But even if I'm were to make like 50% return on that, which would be crazy, it's 15,000, 10,000 USD. That's not worth the time. So most prop firms, you do get banned after a while.
Okay.
Unless you have a very big following. But I didn't want to go that route.
Have you therefore found that your max allocations that you probably had at your peak is slowly getting
Is
less?
this guy doing some kind of like cheese strategy? Is that what's going on here?
Yeah, but there's also cool firms popping up. I think the CFD firms entering the future space, like FundingTix and FundingX Futures in particular, have really impressed me.
I think it's probably because they have the liquidity from the CFD side to just be competitive and have better conditions for the trader. The reason I took this line of conversation was you could either see it as prop firms as a window of opportunity. You got to milk it whilst it's here before, let's say, regulation comes, or before they start banning you and making your life difficult, and your max allocation can go from large to little. But it seems like you're more optimistic.
I think from a practical standpoint, it's always better to think tomorrow is the last day. I think you always should. I've always tried to live in a hurry, to say so, knowing that this could all be gone at any second. I think the word patience get misused for like not taking enough action, not doing enough. So in that sense, I do like to act as if it's all going down tomorrow. But I do recognize that these firms have entered the future space, and they've actually done so pretty well so far. I had expected them to do worse, but so far their plans are very competitive, and I have not seen about any unjust payout denials or many payout denials at all. And so I'm very impressed with those, and I think I think new firms pop up every now and then, a couple a year, that are actually worth using. So I don't think that it will ever completely dry out.
Because you have a very large experience with prop firms, I'd like you to share maybe some red flags of when you are looking to decide which firm to work with. If you want to name them, you can. If you don't want to, that's fine as well. But just like, how can someone know how to navigate who to trust? Because they all have influencers, they all have marketing campaigns, and they all look legit. But of course, some have horror stories and some are actually legit. What has it been like in your experience to navigate them? Yeah,
it's an interesting question, actually. Because I am pretty good at calling them, usually. I think the most obvious sign is when it's clearly better than competitors, especially if if other competitors recently went out of business.
This is a bad sign.
Yeah.
Uh-huh.
So for example, I don't know if you remember Dayfunded. They are like the perfect example of this.
Who's this?
This was a CFD firm that got like launched and rugged. It was about a year ago. So this was when like Funded Engineer was going down. All these established CFD firms, they were going bankrupt, and they just entered the market. They had more drawdown, less profit target, lesser price. So everything was better with them.
But not sustainable.
Yeah, and obviously if these established firms with harder rules are going down, this new one with easier rules, it cannot, it usually doesn't work out. And usually it's like 99% of everyone could call that one wasn't going to work out. So I think comparing how hard
That's
these firms are, is
not
my
particularly useful advice, right? Because like, let's say someone's getting into trading right now and they want to use a prop firm and they watch this interview. How are they going to know what the rules of these now bankrupt companies even were?
way. That's why I'm pretty surprised with the futures firms, the CFD firms entering the futures firms. I think their plans are very great. The FundingTix, Pro Plus, the FundingX Futures, Rapid, and the Legacy actually. It's all great plans in my opinion. So I did expect them to be more shady than they have been. But maybe it is because they grabbed in the pocket of the CFD firm for a bit to kind of grab some market share.
Yeah, if I can just add an opinion here, it's like these smaller firms and the larger firms, there is a big difference in everything. Where the smaller ones might be influencer-led and a team of 5. The big ones, the ones that I know of, and I've spoken to a lot of founders, they're organizations of hundreds of people. And when you have literally $1 billion valuation, you also have the regulator watching. So they're not incentivized to do, let me deny one payout, because they'll rather grow it and sell it for billions. So I think it's a difference in mentality. And they are thinking from a place of longevity. The one place I do think is worth, maybe if you can share some light, is what you're talking about here is like fair practices, where there is a dance between how good the firm can make it for the customer, but if they make it too good and too good for these traders, too many payouts, and it's unsustainable. So there's a balancing act, because it's a B-book model, as you said. So when it is the case, what is the difference between fair practice that the firm should do to keep itself sustainable versus predatory practices that are designed only to trip you up and maybe line their pockets? Is there certain things that you see that like no point going with a firm like this because there's no need for a rule like that?
Do you mean rules that are too easy or rules that are made to make you fail?
Exactly like this, made to make you fail. For example, the risk limitation, I can see where it comes from. But other rules, if I'm to just throw one, is like the trailing drawdown. It's like it just follows you based on your live positions, not even closed positions. This feels like a big hurdle.
It's incredibly
and
hard
it's probably just tripping up a lot of traders. Is there sorts of things that you see that are like these rules? If you see a firm with it, find another firm because there are alternatives that are probably better.
Yeah. So I don't think any rule is predatory. I think what's predatory is when you buy something, you agree, we buy it like this, and then retroactively they say, oops, we're not going to do that anymore. Or when they deny payouts, that's, I think, predatory. But, if you know all the rules, they tell you all the rules, and you agree to buy it at you agree to buy this thing at this price, both parties agree, then I don't think that's predatory.
So I was watching one of your videos where you were debriefing, almost on a weekly basis, and you were speaking about a firm that you were working with, that you've had a great experience with, and then you recently repurchased some evaluations. They probably changed the rules in the meantime. You just didn't check, and therefore you actually said, that's my bad. I just didn't check. But the logistics of managing 20 accounts and each one having a little bit different rules, and the rules are also changing. Did you have any strategies in place to manage the capital that you had, whether it's a spreadsheet or alerts? I don't know. Like how do you logistically pull it off?
So first of all, that kind of gets back to what we were saying earlier, right? When you decide you want to prop trade, there are certain advantages. Like it's way more scalable. I would have never made millions or $1 million out of 2,000 USD just trading regular stocks in 2 years. That would have never happened. And prop firms allow me to do so. But on the downside, there's that you have to keep track of all of these rules. I think being active on X is pretty helpful because most firms, they actually talk mostly through X. Most important announcements are there. And you also get a lot of feedback from the community, which also kind of ties back to a red flag for a firm. I like to keep tabs on X and Discord, because that's usually where people complain first, and usually when there's smoke, there's fire. But back to what was the question?
It was around initially the red flags, and there wasn't really any red flags that you wanted to note. So then it's pivoting around just overall assessments of, okay, how do I manage all of these at the same time? Because let's say even if they're not predatory, some will say you can trade news, others will say you can't, etc. Yeah,
it's very hard. It's been one of the struggles I've had. What I actually did to solve this, I created my own bot to help me with all of this. So to notify me when I had to close certain trades, to notify me when I tried to put a trade, and I would say, you shouldn't do that because you're breaching the lot limits or whatever.
Is this using AI or how
No, I just hard-coded it in Python.
Okay, fair enough.
Yeah.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them and the have trade them all and see what happens.
Yeah.
Or some cycle them, like 5 at a time. What was your approach when you are managing many accounts?
I like to trade them separately as much as possible, but it's not always manageable. So sometimes I have to copy trade them. And for example, if I have 10 accounts that I trade Nasdaq on, then it's not feasible to trade those one by one. So then I'll copy trade like 3 or 5 at a time. But if I just have one GJ account, one Nasdaq, one gold, one US30, then I think it's perfectly fine to.
Based on asset class. Okay.
Yeah, exactly.
So there's one more thing I wanted to touch on before we pivot topic, and it was regarding risk in the arena of prop firms. And I like the way you tweet, so I'm going to read it as you wrote it. Broke ICT trader. Risking more than 1% per trade is gambling. That's their opinion. And then Warren Buffett says, there are situations where it would be a mistake not to have half of your net worth in a single trade idea. There have been times where I've had 75% of my net worth in one situation. The broke ICT trader would be saying making more than 2% in a single day is gambling. Michael Burry, obviously a famous investor, lost money on a single idea for 3 years straight before he made him $800 million.
Yeah.
I guess Warren Buffett and Michael Burry are just gamblers. So I can see the point you're making here.
Yeah.
What is the lesson you want to take away from these great investors, comparing it to the noise you'd see on X, let's say?
I think the key takeaway is that everything can work, and that the broke ICT traders, they are so set on their best practices and on their specific rules that they completely neglect the fundamentals that actually made these rules or these best practices in the first place. So for example, about the 1% risk per trade, it used to be a pretty solid best practice, and when people were just trading personal accounts, because you are risking enough to make some money, but not too much, and that your risk of ruin gets too high, and probably not too much that you start getting emotional because you're losing 1%. So it used to be a pretty solid best practice, but it relies on these underlying assumptions that are just not valid anymore in prop trading, but also for some of these great investors. It's about understanding the principles and applying them to your trading. And that's why you have Warren Buffett saying something completely opposite to what 99% of trading Twitter would say, is because he understands the principles behind them and he's able to apply them. And sometimes you get crazy results by just thinking for yourself. And I think especially the ICT traders, to kind of dig it in a bit more, they are so set on doing exactly what their mentor tells them that they don't understand anymore why he even said it in the first place. They completely miss the plot. For example, about the risk thing, is you want to make as much as possible, so you want to risk a pretty high amount. I'll dive into this a bit deeper. Give you an example.
Sure, let's do it.
Say you have this magic money machine, and whatever you put in it, you get twice the amount back. So if you put $1 in, you get 2 back. If you put 5 in, you get 10 back. Obviously, you'd want to risk everything you got, right? So in trading, as a general idea, the more you risk, the more you will make, as long as you have an edge, right? If you don't have an edge, don't trade. But if you have an edge, you want to trade as much as possible. You want to risk as much as possible under 2 constraints. The first one being you want to keep your risk of ruin manageable. Let's change the money machine. Let's say whatever you put in, there's a 50% chance it's all gone, and there's a 50% chance it 10x's. Obviously, this machine has massive edge, but you wouldn't want to put in everything every time, because once you
50-50.
because once you will lose, it's guaranteed you will lose everything if you just keep risking 100%. So that's one constraint, is you want to risk as much as possible to make as much as possible, because it's a waste if you only put in $1 USD whilst you could have put in 1,000, but you want to keep your risk of ruin manageable, because else you'll end up broke anyway. And then in trading, there's one more constraint, I would say, which is you don't want to risk this much that you can't follow your plan anymore, because the magic money machine is just pressing the button, right? Trading is slightly different, as in there's some executional prowess to it.
Yes.
You need to be able to be in the mind space to execute properly. And some people might say, for me, when I risk more than 2%, that stresses me out, I get greedy. And those are the constraints. But the general idea is you want to risk as much as possible under these 2 constraints.
It's a nice analogy. And to build off it, when it comes to the market, the magic money machine, if we're referring to our edge, everyone's going to be a little bit different. But let's say someone says I have a 50% win rate and a 1 to 3 risk reward on average. Okay, you have a positive expectancy, but it's not going to be like all your trades are exactly that. Some of them are going to be a better win rate, some are going to be worse, some of them may be home run trades that have a better risk reward, some of them may be a 1-to-1s. So you have a variety of trades that build up your average KPIs. Yep. The reason I'm mentioning this is because when I see, let's say, the Warren Buffett quotes where he's going big on one trade idea, it's probably one of those trade ideas that's just A+++, and it's once every 5 years, and you look out for it and you manage that idea differently because of the extra positive expectancy. So with the money machines, it's like you have different money machines for different trade models, and therefore, how do you manage risk to balance both sides, as you're saying, of like risk of ruin versus how much you could make when it comes to trade models? Meaning to say, let's say you did 4% risk per trade, as you were saying at one point. Would that be standardized, or would that be based on setup types you have, and higher conviction plays equals more risk?
Yeah, it depends on the win rate and whatnot.
Get back to Warren Buffett then and Charlie Munger. What they pretty much say is only take the A++ and skip all the rest. And I think that makes perfect sense, and that's also how I did it.
Okay.
If I see the trade with the highest possible expectancy, I'll go all in. And if I see a trade that's an A or a B or whatever, and not an A+, then I just wouldn't touch it.
And as a result, is it natural for you to have hot periods in the market where in a month you have a bunch of trades and then other months you have a dry period because you are looking for something very specific?
Yeah. For example, the Apex accounts, I took, in total, I think I had about 20 trading days on those, maybe 30.
Okay.
And I had them for 9 months. So
Oh.
that's patience, I guess. So yeah, you can't force it. If there's expectancy, then you grab it. If there isn't, then you leave it alone.
So that's actually very interesting for me to hear, because I think time amplifies emotion, because you can sit and ruminate on it for months. And when you were mentioning the 700K where you decided it was weighing on you and you didn't want to go for the million anymore, I figured it was a decision over a day or two. But it seems like you were sitting on it for 9 months and you were building it for 9 months. You probably had drawdown periods and win periods. This is an important topic, I think, which is risk-adjusted emotion, but then also time-adjusted. And the reason I say this is because prop firm environments, it seems like it's catered for quick trades, like try and get a scalp, try and get an intraday trade and not invest in the S&P or swing trade for too long. And I feel because the numbers are larger than someone is used to on their personal capital, that huge number that you're seeing in floating profits, but times that by 2 weeks, a little drawdown is going to be a change in the number that you're not used to seeing, and an emotional decision will come. How did you then specifically manage time under this pressure and performance for so long?
It's all about getting busy doing something else. I think that's like the number one tip I have for like sticking to your plan. I'm not stalking charts, not overthinking, not overtrading. Is if you're just working on something, then you don't have time, or you're not going there because you're so focused on something else.
What was that for you?
I learned to code, for example. That was one of them. Trading other accounts was one of them. I'm working on like a software company now. I'm just, whatever it is, there can be so many things. For me, it was learning to code back then. And then when you're learning to code and you're so focused on that, then there's not this voice in the back screaming, buy, sell, because that's, people really make it hard for themselves when they know they're done for the day and they just have the trading view open and they're just looking at it. Every second, every candle, you have to make the conscious decision, I'm not going to do it.
Yeah.
So this decision had only to be made once. You say you're done for today, done for the week, and you close it and you're done with it. But when you keep looking at the chart, you have to fight this battle every second, every minute, every candle is no, no, no. You just make it so much harder for yourself. And I really think the best way for me to kind of fight that is just do something else in the meantime.
So I had a trader on the show about 2 years ago, and he had 5 million plus in funding. And I know back then it was a different era and it was easier maybe to do so, to have that much capital because there was more firms and options and easier rules. And he had, I think, around 7 figures in payouts too. And I was having a similar conversation with him, and he also noted that he had his main portfolio with copy trading, and then he had 1 or 2 accounts, let's call them fun accounts, where he would just to scratch that itch. If you're getting impatient, whatever, that was the place to mess up or express that. What is your thoughts on that?
First of all, like, it clearly worked for him. So whatever works for whoever, I'm all for it. And that's one of the recurring themes. It's like in trading, it's whatever works for you. So if that works for him perfectly, and it apparently did, so go for it. I think it's a pretty smart solution. So yeah.
This topic of psychology is basically what we're referring to here. A lot of people know what the big constraints are, and patience is obviously a huge one. And it's funny for me to observe that people do extreme lengths to solve patience, which is when I sit in front of a screen and I'm having these thoughts and emotions, I have to do nothing. I have to be patient. But the easiest thing, as you're saying, is just close it and walk away. Then you don't need to master your mind and be patient or anything. You just know what to do in the meantime. What is your thoughts in general on this topic of psychology, and is it underrated or overrated?
Oof. I think it gets the blame for a lot of things that it shouldn't. I think a lot of people, they think they're not profitable because of psychology, whilst their strategy just isn't good enough. But I still think it's incredibly important. I think a trader's journey pretty much boils down to finding a working trading plan and then being able to execute it properly in that order. And I think 90% of people don't have a working trading plan, yet they are focused on
psychology.
Yeah, it's the same as in business, that you're practicing how to take sales calls, but you don't get any calls because you don't do any marketing. It's useless. It might be useful later, but it's not a constraint.
Yeah, someone nicely put it. It was like, if you take someone like what's his name, David Goggins. elite mindset, warriors, psychology on points, but he just off the bat he wouldn't be a great trader because he doesn't have the edge first. I wanted to also mention one more thing from your Twitter. I missed the screenshot anyway, but yeah, it's talking about still on this risk idea. So we're talking about this idea of like out of the whole year, it's not every day is an opportunity, and then you have hot periods and not hot periods. And for you, it was 9 months to have 20 trading days, and then you have high conviction. You size up on them. Would therefore dynamic sizing not be a concern for you? And what is then the next step, which is trade management in terms of profit-taking systems or scaling in? You break even a first position, add another 4%. What is that journey like to scale to large numbers in prop firms?
Yeah. So I risk pretty much I decide beforehand how much I'm going to risk in a trade on an account, and that's how I do it, because I think just like you have a trading plan, you need to know, you don't buy an account and then once you bought it, figure out how to trade it, right? You figure out how you're going to do it and then you buy the account. I think it's the same for risk management. You figure out in advance when your head is clear, you figure out this is how I'm going to do it, and then you just stick to it. I think for that it's useful. It's useful that it's as mechanical as possible, because that's way easier to stick to. For example, if your plan is just, I risk 2% on a Monday, 1% on a Tuesday, that's pretty easy to follow. So you probably will be able to follow that even under stress. But if your plan relies on certain things that you see in the market and certain, especially on the lower time frame, certain candle structure or whatever, then you give yourself a lot of room to fail because you got to make this high impact decision. You got to make it quickly. So I prefer to, in advance, I figure out this is how I'm going to do it. And then I just stick to it for at least that account. For the Apex accounts, I decided in advance I'm going to risk 20% on every trade, 20% of my drawdown. And so at the beginning that was very little, right? Because I started with 4.5k drawdown, so it was $1,000 of drawdown. But as these accounts grew larger, so did the stop loss. But it was decided in advance, and it was easy enough that I just didn't have to, in the moment, be like, oh, what am I going to do? It depends on this. Just very straightforward. And I think when you're figuring out a trading plan, it's also quite useful to make it as mechanical as possible, because it gives your brain less room to fuck it up. A lot of people get tricked by their brains, by biases, by heuristics, and they allow those to make their trades look better than they actually are. They journal, oh, I would have taken this, so I'm just going to count it in, or yeah, maybe I would not have taken this L because I feel it in my stomach, but I feel it in my stomach is not very reliable to get a trading plan off of.
Funny as well that people tend to journal their wins, but try and avoid journaling the losses. Like there's a lot of these things in place. So what you're describing here of like having a predefined plan and decide that in a calm state, prepared for the occasion of prop firms, and then follow that plan. I think a lot of people may think they're doing this, but in the end it's hard to follow it. So why do you think people struggle with this idea of like, on a Monday I risk 1%, Monday comes, they're 4 trades in and they risk 20%. Like why does this happen? Why do people struggle to follow a predefined plan?
Because they're clueless?
Because
they're
it's hard
lost.
is the answer, and people don't like hard. And it's one of the questions I get asked the most is, how can I be able to stick to my plan better? Which book should I read? Which breathing technique should I use? Which whatever. But this is just something you got to do. It's the same as trying to get abs by reading about getting abs. It's might help a bit, but the suffering isn't optional. You have to go to the gym. You have to do the plank for longer than you want. You have to skip on the burger and eat a salad even whilst you really crave a burger and everyone is eating one. Like it's in fitness, for example, it's very obvious that the suffering isn't optional. You just gotta do it. But in trading, people, and especially in risk management and psychology, people still seem to think there's like this holy grail, and once I read this book, or once I did this meditation or whatever, then it won't be hard anymore. But it always is hard. It stays hard. You just get better at doing it.
I've spoken to a variety of guests on the show, and a unanimous common denominator that leads to my belief of the show, you'll get the best discount using the link in the description or code TOT for Titans of Tomorrow. So I'm going to explain my scenario, and after that I would like you to share what you think and what works for you. My belief on psychology is exactly as you're describing, where it's important but it's secondary to an edge, because if you're trying to build psychology and you're doing everything right but you're building on a flawed edge, you're making your psychology work worse because you're trying to believe in something that just genuinely doesn't work. So it's first and then second. And then when it comes to psychology, when I look back in my career, which is now 10 years, I never really sat down and had a long period of meditation. I never did the generic things, whether it's breathing techniques or the cold showers. Maybe I did it for other reasons, but I never found it drastically affect my trading performance. But what did, and I think uniquely did for me, was like the gym. It's just, you can't skip the suffering. It was just market experience. The first loss was painful. The 10th loss was painful. The 100th loss, a little bit less. And then, you just desensitize, you acclimatize, market experience comes in. And I think it's just time for me, psychology improved with time. And secondarily, when I realized where are my unique blind spots based on my personality, based on my risk tolerance, I don't like sitting in a trade for 3 weeks because 3 weeks is a lot of hours and it takes me 30 seconds to mess it up, where I just jump out of a trade too early because it draw down, all of these things. So I decided, okay, swing trading is not for me. I adjust my strategy. Or when I realized that I don't like being wrong, and I think that's a natural feeling, I break even very aggressively. And even if the trade now taps me for break even and goes to profit, fear of missing a trade or a missed opportunity doesn't hurt me as much as a loss. So then I realized, okay, aggressively break even. And if you miss the trade, you miss the trade. That works for me. Maybe it doesn't work for someone else because the fear of missing a trade is heavy for them. That's how I navigated psychology and adjusted a strategy accordingly. What was your journey like?
So what really helped me, and to get back to the point from earlier, was just I don't move my stop loss, I don't move my take profit. So I enter a trade, and that's that. And it's mostly because I used to move my stop loss, and it would really break my heart if I moved my stop loss.
Because it's basically the opposite of
out.
myself. Interesting.
Yeah. So it's again the whatever works for you. It's also I like to keep it as easily backtestable as possible, and this is very easy to backtest and very hard to trick myself because there's no, but if I really took this, then I would have put my stop loss to break even or whatever. There's none of that for me. So that's the way I do it.
So this idea of never breaking even, some would say controversial, because I can understand the wisdom behind why you're taking that decision. It's for a psychological edge that works for you that maybe doesn't work for someone else. But when does, let's say, logic come into place? Of like, have you considered?
Not necessarily.
Like,
for
example.
Like if you're doing some strategy where like you've tested it with like this target set and that's your stop and you just repeat it every single time and it's profitable, then like putting your stop loss break even or not is just the potentially ruins the data from your strategy, right? Because there'll be times where like you get into the trade and then like it goes a little lower, then it goes, and then you put your stop break even, and then it like comes back to exit, and then it just goes, right? Like you're gonna be stopping yourself out of like winners and losers, which then like this kind of ruins the whole point of like collecting data and repeating the strategy over and over.
You have a big trade and it's a large amount of money and you're about to request a payout and you're
But it is subjective, right? It's subjective at the end of the day. But I'm definitely a big advocate of break-even stops.
Profit level. So like it's more likely to take your take profit and you don't want to take your stop loss. Maybe at that point, should I break even? Is there any considerations or is truly never break even?
There's no considerations. I have this plan and I know if I stick to this plan over the long run, I'll make money. Right? I know it because my backtest data suggests it. I know it because it's been true for the last couple of years. So I'm just going to stick to that plan regardless of anything, because I know if I just do this and nothing else and nothing more, nothing less, if I just do this, I'll be fine in the long run. So that's just what I do, and there's no ifs or buts or maybes. It's just it's the same as the risk thing. Is I say in advance, before I buy a chance, before I get into it, I say this is what I'm going to do, and that's what I do, and nothing more, nothing less. And maybe so there was a point I got very often that my trade went to TP, couple pips shy, and then hit stop loss. So what I did then was not start cutting trades short. What I did was I ran my backtest data again. But now I tried, what if I changed my stop loss or I changed my take profit on these metrics? Didn't turn out more profitable, so I didn't change it. And I think that's how I would recommend people to do this. You don't want to make changes while you're in a trade or while you're in an account for that matter. I mean,
that's pretty egregious, right? And miss the thing by a couple of ticks and you get stopped out for a loss. That's pretty ridiculous.
And you lock it in and you play it out, and then when it's said and done, you can use data to reconsider it. But I'm sure you can handle it, but I think most people would not be able to handle the authority to make those kind of decisions during a trade or during a challenge. I think most of them would start to hesitate, maybe change their rules a bit. Oh, this one is so close, I'm just going to close it. Then it hits the take profits, or then they're like, oh, next trade I'll make it up, I'll add 5 pips. Then it get messy.
I really like what you're saying here, because you got to make decisions on what, and it can't be just on your last 2 trades, because that means nothing. And I like how you're also saying that you will only take a decision, not in the trade, not in the accounts, but like in your backtesting, and see, okay, not in 1 or 2 trades, how did it benefit, but like on a long back test, what is the net gain? Because it's in trading, it is true that something that is counterintuitive helps you. So in my case, one of those things that surprised me was I used to take profit at large TP levels, risk reward wise, based on market structure and so forth. And I realized based on a large sample size that the best place for me to take a partial was 1 to 3. And I was never taking a partial at that point. I was always waiting for more. And yes, there's certain trades that went to a 1 to 5 and I cut it at 1 to 3. Sure. But I know if I now made my TP 1 to 5, overall on 100 trades, I'm actually making less money. So when I have the data, I have the confidence, and then I don't feel the psychology because I know this is going to benefit me long term. Maybe on this trade not, maybe on 5 trades not, but on long term, yes. And it's basically like what you did for 9 months on your Apex accounts. Like I know what works, and micro decisions maybe help me today, but not in the long run.
Yeah, that's exactly it. I think you should make the decisions in advance. I think you should make them data driven. I think most people drastically underestimate the amount of data you need to actually figure something out. But it's worked fine for me, and I think it's a great way to go about things, to really get a big sample size, to make it as mechanical as possible. And if there's one psychology hack that I would give, then it would be to know your data, because that's the one thing that really might, if you're 100% sure, like I am, that if you're just going to do this exact thing, just going to do this thing for a year straight and you'll end up green, then it's way easier to just do that one thing. But most people, they backtest 100 trades and they deep down they know it's not enough. But they're like, oh, okay, FOMO, they're just flying in. And then once they're in the trades, then they start doubting themselves. And is 100 trades enough? Maybe it was just a lucky streak, maybe. And then it goes to shit. So I think if there's one psychology tip, it would probably be to have undeniable data that your system works, or as close to undeniable as possible. So yeah, I think it's underrated.
I like it because I think when we talk about psychology, it's solved by confidence, maybe one of the things. And confidence is what? Well, it's like what I think will happen happens. And what do I think happens is based on evidence I have before. So if I walk on a stage and I think I'm going to die because there's so many people watching, and then I do it 100 times and I didn't die, well, then I have evidence that is irrational thinking. So the only evidence you can have to build confidence in the market is your trades taken or the data you've taken from backtesting. So it makes total sense to me. Now, when you came on the show, you said you didn't want to talk about your edge, and I'm going to respect that. But I'm going to try and pull something out that at least the audience can take and say, okay, how did this guy make $1 million from trading? What strategies are key here? So if you can give me generals on what has worked for you specifically with prop firms and large payouts, and overview on a top down of a trade idea you would take.
Okay, maybe just like one small caveat there is
Gotta be pretty niche, right? Some kind of like high time frame reversion or breakout. He's taking 20 trades a year. Gotta be like a pretty obscure thing
for the big payout. But I have about $600,000 in other payouts as well. And so I started trading small and consistent and with a lot of small payouts. So this is also applicable to like the people that just want, because I wouldn't recommend if you're just starting out aim for a $700,000 payout. You're just saying I made $600,000 in like small payouts as well. So sorry, what was the question again?
Yeah, it's just kind of giving some insight on a strategy that traders maybe are utilizing. And I think everybody knows the common strategy, especially people that follow on X. But kind of what worked for you, and without having to reveal your full edge, which you didn't want to, but things that someone can take away and say, okay, he mentioned this is what I should look into. Yeah,
okay, so I think once again, like the main thing is just whatever it is, backtested enough. That's the main thing when it comes to strategy creation. What's worked for me is pretty similar to what's worked for most, I think. I think most successful traders, they don't just completely copy, but they scoop around and they try a bunch of things and then they kind of create their own little thing. Same for me. I don't know anyone that trades exactly the same, but we all share a lot of concepts. So I start off usually at the 4-hour bias, long-term bias. Now this is more of a Forex thing, because usually with indices, you know the long-term bias is up, usually, just fundamentally speaking. But I still check it, and actually the biggest trade of my life on the Apex account was a sell. So
on an index?
Yeah. Okay. And I buy 80% of the times. So this was one of the 20% that worked out really well. But yeah, I start 4-hour, just trying to figure out long-term, where is this thing going? Then based on that, I use structure a lot. So I look a lot at structure. I try to figure out important sections of the structure. So the point that broke the previous high, the previous low, or what I call the extreme, which is just the complete extreme, the last part of the current structure. Then I mark those out. I look for Wyckoff, which is, yeah, for those that aren't familiar, it's kind of like ICT, kind of like smart money.
Yeah, it's an old school theory that is like
Wyckoff schematics.
I don't know, 30, 40, 50 years. Yeah,
it goes back very far. But it's
Interesting.
Very similar. It's what some people would call like a liquidity grab. It's pretty much that.
So are you looking for specific?
He does like a mean reversion
theory,
then.
old school schematics, an accumulation and a demand, a distribution and supply.
Yeah, exactly.
Okay.
But those tend to happen very often. So I tend to only look at them on the 4 hour. I'll mark my important areas of structure. Then I'll look into those. Usually I just set my alert. When it gets there, I'll look on the smaller time frame, and then I just do the same for the 50 minutes, and then I do the same for the 1 minute. So it's the same thing and the same thing and the same thing. And that allows me to usually have pretty tight stop loss and pretty big take profit. Although I did kind of have to change that a bit for the prop firms. And so now I usually keep my stop loss a bit wider.
Hey, we posted this in the Discord,
don't go
but
on the 1 minute that much anymore.
When it comes to this kind of model, which I can very clearly visualize,
he probably
let's say
trades like the
supply zone, you get a
springs,
distribution,
right?
And it's 4 hour supply. So you know, well, the target could be a 4 hour lower low, and you're just continuing that bearish trend. Now that could be hundreds of pips. It could take days or weeks to get there. And that's probably, what is it, optimal for prop firms? Or are you entering based on that, but exiting based on something else?
It's not optimal for prop firms because they charge way too high swap fees. And some of them even just
force close.
Yeah, or they get this ridiculous slippage. One thing about the prop firm game is you have to be kind of perfect. Meaning, if they get the chance to fuck you over, maybe they won't, but you should expect them to do. And what I figured was, if you stay in a trade overnight, first of all, some prop firms just don't allow it, so then you're screwed. And with other firms, they just, apply this massive slippage, step you out, and it's not completely unreasonable because there is a lot of slippage at night. And in the forex world, nobody really knows what the slippage should be. It's different than the futures firms. So it gives them the chance to screw you over, and I think you should give them that chance as little as possible.
Makes sense.
So usually I close them earlier, but I just have the trend. For example, the Apex account, I sold for 3 days straight. I was in sales for 3 days straight. That was like my main run on those accounts.
Is your exits based on risk reward, time in the trade, or structure, or something technical based?
It depends. I try to also keep in mind the profit target of the prop firm account, because obviously it makes no sense to aim for $20,000 in profits if you only need 10 to pass the account. So usually I work with I'll keep to here at most, but if I hit the profit target, like the target of my account quicker, then I'll just close the trade more quickly.
I finally have a special offer to share with all of you from the US on Broad Street Power Plus.
Pattern. It's very interesting
Scouts in the industry to make this a home run offer if you are a futures trader.
So Wyckoff theory is a very interesting school of thought. I went very deep into it in 2017 and 2018. And then, as you actually put, it's very analog, to be honest, a distribution schematic. For another eye could be a head and shoulder pattern. For another eye could be something smart money with the liquidity sweep. For another eye could be a trend line test. There's all kinds of ways to label price action. So I don't think it's important to say, okay, what's right or wrong. It's just about, okay, what's the meaning here? And I think the magic is in the nuance. And one question I have, because this is a question I faced at the time when I was utilizing Wyckoff theory, was distribution and supply waiting for an expansion to make a low. In theory, perfect. But the nuances here, well, when you get the UTAD in a distribution, or let's say the liquidity sweep, the final high before it starts to then go lower, that could either respect the supply zone or wick through the supply zone. So therefore, where a lot of people are looking to get in on that liquidity sweep, it's hard to place the stop loss because it might just be the UTAD or it could be the zone overall. Are you interested in that area, or are you waiting for zones after that?
Usually zones after that.
Okay. And that's waiting for fractal distributions along the way on a lower time frame.
Yeah, or
so distributions inside of distributions kind of thing. And the area of interest for you is the test, I guess, after the UTAD has happened.
Yeah, or just like following structure. As I said, I was very big into structure, so just even like a basic retest. If it fits the criteria, I'll take a trade off.
And with this, is fundamentals a big consideration for you?
Yeah, they should be for everyone, I think. No, that's wrong said. You should do whatever works for you. But I think they are undeniably important in moving the market. So you don't need to understand them to have an edge. But you can't deny that when there's a lot of money being printed, then asset prices generally will go higher. These are very fundamental, very basic concepts. So yeah, I like to always keep those in mind.
And is this to help you qualify trend and qualify POIs? It's through fundamentals, basically.
Yeah, especially for trend, I think it's very important. It gets back to like the indices thing. You can be pretty sure they will be bullish long term because they will just keep printing more money. So it's pretty unimaginable that any of the major assets will be down in 10 years, say.
Even in the presence.
So I think that's also a big advantage in trading assets over forex. Is if you're trading Euro USD, you don't really know. Over the long term, it's harder to say where it's going. Whilst with gold, you can be pretty sure it's going up. With indices, you can be pretty sure it's going up. I'll bet on it.
No, it makes sense. Like indices is baked into the nature of the economy that they'll appreciate because of
Yeah.
printing. But a healthy currency exchange, in theory, should be consolidating, because if it's trending in one way or chopping around, it's like it's unstable, and that's not what economies and currency should be. So yeah, I think forex is a lot harder to master that trend thing.
Yeah, and obviously, like sometimes it's useful to devalue one currency or to appreciate another, but it's way harder to predict those kind of things and to predict interactions between central banks and
Trade wars and all
yeah,
these other.
that's really hard. Whilst they probably will keep printing money, so assets will probably rise in prices, like a pretty sure thing. It's easier to predict.
I wanted to touch upon, which I wanted to pull the screenshot, I couldn't find it, but I remember reading a tweet that you said that now that you've reached these larger payouts, number one was 50K a month with prop firms seems like it's on autopilot. And now that you have this level of finance where at a young age you made a huge amount, that trading isn't doing it for you anymore. Either the fulfillment or is the game just to keep chasing more money. And it seems like you're having these more philosophical questions with yourself. So number one, let's talk about the 50K per month on autopilot. What does that look like? What does that feel like to you?
Nothing crazy. It's an interesting question, because I remember 2 years ago when I didn't make that much money, or maybe 3 years ago when I didn't make any.
No, honestly, this interview,
remember
like,
making-
not particularly informative or anything like that. Like, whatever, kind of just the usual shit. But it is impressive that this guy has this kind of mindset at this age, right? Guys, like, he said he started at 18. He's been trading for like 4 or 5 years, he said. He's like, what, 23? Pretty mature for his age. Like, that's why I wanted to know where he's from, right? He seems to be from one of these, like, Nordic type of regions, right? Just very like a stoic, mellow personality.
At guys that made this kind of money and be amazed at how it feel or how it would how everything would
German or
feel, but I
something?
found it to be,
Slavic?
actually. But maybe that's because I don't spend that much money, and so I make quite a lot. But as you can see, I'm a pretty regular guy. I drive a usual Toyota. I don't wear the designer clothes or whatever. So maybe that's why I haven't found it that impactful. But it's pretty same thing, to be honest. There's a lot of convenience in it, which I really like. Like I don't have to cook.
I wish I was
don't
like
have
that
to
at this
wake up early, I
age.
don't have to
Or at that age,
drive,
I should
do
say.
those things, and that's really nice. But you don't need $50,000 a month for that.
Yeah, I remember reading a tweet of yours from more than a year ago where obviously your net worth was a lot less, but you were having the similar thoughts. And the idea being that you solved the initial problems you had, and that was solved with a relatively small amount of money. So everything else for you is just excess, seemingly, and something that you don't necessarily desire. Why has then that reflected on your
His
trading? in the
LinkedIn
sense
says
of
Belgium.
looking towards other things, or because now you found a cash cow, something that's working for you, something you can do on autopilot, and something that you at one point really enjoyed and hyperfixated on. Why has that changed for you, you think?
I think a big part is that it isn't necessarily intellectual challenging anymore. So I think, but that's why trading is so great. It's one of the reasons why it's so great, right? Because once you figured it out and once it clicks, it doesn't take that much time. It doesn't take that much effort. I just trade a couple prop firms that I really like. I'm able to make a lot of money from them with very little time, which is great. But it's also not that challenging anymore. So it's still stressful. It's still rough sometimes, but I wouldn't call it intellectually challenging or stimulating anymore. And I think that's a big part of it.
We talked about this, right?
on
Like,
another note,
this is like a game where like you rank up and everyone else just continues to suck. It gets a little boring after a while.
I also think that trading is fundamentally it's a zero-sum game, right?
Yeah.
And that's something I struggle with. I don't want my legacy to be being great at a zero-sum game. I want to actually contribute something, and I'm not hating on trading for it. It's, we all play this game, and the winner gets the money, and everyone agrees. So it's completely fine. But I don't want to do it for the rest of my life.
To be honest, I don't know if everybody's gonna understand what you're saying here, but I think it's very deep. What you're explaining here of like the fulfillment side of a zero-sum game, and that all you want to pursue and chase. It says a lot, I think, about how you view life and just pursuing yourself, fulfillment, passion, and these other things, challenges. I think that's a nice reflection. And I think to end off, if you can share one piece of advice to someone like yourself a few years back, where you were obsessed, working hard, sacrificing friendships and all these other things, yet hadn't found the results at that point, what kind of message would you say to that younger version of yourself?
Oh, that's a difficult question, because it gets back to like a very fundamental thing. It's the same thing. Trading on autopilot can still make me a ton of money, is because the effort you put in is pretty uncorrelated to what you get out, right? I can put in very little effort and still get out a ton of money. And this is pretty unique to trading in this extreme sense, right? In business, it's like that as well. But in trading especially, there's very few businesses where you can just make $50,000 a month without, spending a couple hours a week working on it. But I think that's also a disadvantage for most beginners, because in the website business, every hour I put in, I would make more money. For every mail that I sent, every sales call that I took, every website that I built, I would make more money. In trading, it's not like that. I know plenty of guys, smart guys, hardworking guys that have been doing this for 5 years, that still don't make any money from it. And so probably quite controversial, but I don't think trading is the right vehicle when you're broke, because you can't. 99% of the jobs you can just work really hard and make a lot of money. And when you're making websites, I can almost promise you, if you 5 years and you just completely obsess over websites, over Facebook ads, over whatever it is, 5 years, and you'll probably get really good at it and you'll probably make decent money. But with trading, it isn't like that. So I would actually say, be careful when you pick trading, because in the end, the results are so uncorrelated to the effort, and man, that's quite risky. But if you do decide to pursue it,
I don't know about that. There's a bit of a caveat to that, right? It's uncorrelated to mindless effort. If you're just sitting here looking at this shit all the time and not actually being productive and doing whatever, then yeah, like there's no correlation. But if you're actually being like thoughtful about what you're doing and improving on things in like a methodical manner, then pretty hard to fail.
Important that you think for yourself.
Because the blueprint is out there, right? There's so many blueprints out there to figure out what works and what doesn't.
That you think in first principles, which also I try to do as much as possible in this podcast. You don't want to know the best practices, you want to understand the principles behind them, be able to apply them. I think that's a very underrated skill set. I also think there's plenty of greats that released all kinds of stuff to learn from. Charlie Munger has this whole book, it's 500 pages, incredibly interesting. Warren Buffett releases all the shareholder letters. He's done it for 40, 50 years. There's this biography about Jim Simons. There's these greats that just published everything online. There's Ray Dalio, for example. Look into those, I would say, because they really know best. There's no internet trader that has done anything closely remote to what they have done. So I would say,
shout out to Jim Simmons.
Listen to the
sad when he died.
A beautiful episode, my man, and thank you very much for joining us today.
Thank you.
There you go. Boom. Really, man. Excellent. Thank you very much for joining us.
Very sad. Go to the math. Should we power through this? Power through this thing.
I made a fortune on SpaceX. I'm just looking at it now, like a bizarre fortune. Charts don't lie, people do. So you always have to look at what the chart tells you. We're going to go back to 100 in the next 6 weeks or 6 months because we're going to get a dovish Fed share. They're going to cut rates down to 2.5%. Is as bullish as it's ever been. The flash crash was terrible for this industry because it took out 20 to 30% of the market makers. AI is a bubble, and my guess is it's going to become the greatest bubble of all time. It's such a powerful story. Altcoins have sucked because they were designed to suck. The number one rule of investing is don't die, which means don't be stupid. Don't bet everything. Here's my other dirty secret.
Good morning and welcome back to another episode here on the Coin Bureau podcast. Now, today, our guest needs no introduction. It is, of course, Mr. Mike Novogratz, the CEO of Galaxy Digital, a TradFi veteran, ex-Army helicopter pilot / pro wrestler, and a real crypto OG. So, Mike, a very warm welcome to the Coin Bureau.
Thank you.
Great having you, man. So before we dive in, guys, a quick few disclaimers. Nothing in this episode is financial or investment advice. Please consult the disclaimer in the description for more information and consult your financial advisor before making investment decisions. Mike, so right now it seems there's a lot of flux in the market. It's pretty clear that the year didn't turn out as most of us had hoped. Your head of research recently came out and he revised down the price target from Galaxy Digital for the end of the year to 120K by the end of the year. But it seems
Yeah, he's got 15 days and a lot of
Yeah,
explaining to do.
Alex is going to have a lot of explaining to do with these bosses if he doesn't hit those price targets.
Yeah, I don't think we're getting there.
Yeah, but you recently said in a pod with Anthony Scaramucci that it may take some time to get back above 100K. Let me start with an open-ended question right now then. How are you reading the market right now, and what are you looking forward to in the new year?
Listen, so I had a sign in my hedge fund, charts don't lie, people do, right? The charts don't lie. So you always have to look at what the chart tells you. And when you look at the Bitcoin chart, we spent a lot of time above 100,000. 100,000 was a psychological big issue, right? We got to 100. We all felt like we accomplished something. I mean, I even put out a tweet or a post where I congratulated the community. I congratulated Galaxy, like this big accomplishment. There was a tremendous amount bought above 100, right? And we came and held it a few times. When you finally broke below 100, if you look at the chart, you can draw it. There's this very nice horizontal line. That's when we accelerated, went from 100 down to 85 or 82,000, whatever the low was, real quick amount of time. That's people stopping out. That's people putting short positions on. So now that 100 becomes resistance. Normally, you don't go right through that 100 the first time up. You might trade up there and roll over again. There's a lot of trap longs, right? People that bought above 100 that at one point just want to get out of this thing. And so, it corresponds with the 4-year cycle that you hear so many people talk about. 4-year cycle ended just recently. There's a self-fulfilling idea that from a lot of crypto OGs that, come back in 9 months, 10 months, and it's time to buy it again. And so I don't know if we're going to go back to 100 in the next 6 weeks or 6 months. My view is we do, because we're going to get a dovish Fed share. They're going to cut rates down to 2.5%. We're going to get good legislation passed in the United States, I think. And having just got back from a week in the Mideast, I'm more convicted now that the future of blockchains and digital assets, real world assets on blockchains, is as bullish as it's ever been. That doesn't mean the price of, you name the token, is going to go up in the next 6 months, right? Being bullish on building out the infrastructure of neobanks and distributing Galaxy stock or Tesla stock or Google stock into places all around the world, that's going to happen. That's an 18-month to 3-year build out process. And so we're kind of stuck in between this new bullishness that the industry finally arrived. And we still have all these tokens that need energy, right? Because most of the tokens that exist today are tokens that represent something, right? They're community tokens. They're not equity-like tokens. Hyperliquid being an exception to that, right? Where you can easily look at the math of how much Hyperliquid does. And so they're tokens that need storytellers.
These
tokens
metals,
that need
goddamn.
new liquidity. It's just going to take time to rebuild that, right? The flash crash was terrible for this industry because it took out 20 to 30% of the market makers. And since that flash crash, I don't care if you talk to the guys at Binance or Bybit or Kraken or us in the institutional, volumes are down 30-odd%. That means liquidity is down 30%. And every
Is that
time
actually
we've done
true
that
though,
in
or
the
is this guy
past,
just talking out of his ass?
it just takes a while to rebuild. How does that get rebuilt? Well, in retail, people get paychecks, they sell other assets, they slowly start gambling again. And institutions like to buy on momentum. I think we have kind of sideways and less than thrilling markets for a while, and you got to watch where it bottoms, and then we'll have another run up.
Yeah, there's many things I want to touch on there. I think starting with one of those, and this is that it relates to, you mentioned the OGs. And if I recall, there's been a lot of distribution from the OGs over the past few months. And if I recall, Galaxy executed one of the biggest of these transactions, like $8 billion worth for one single OG. And that's just one of them. And there's been a lot of distribution. We've seen it on chain and all that. So my question to you is, like, this distribution from the OGs cashing out, how much longer do you think this can go on for?
God, I hope not much longer. Listen, I wish I knew. I
don't know if people even ask these
we saw the
questions. Like, what kind of answer are you expecting to that question? Who's going to answer that with any kind of accuracy?
got done. A lot of it's come from China, and we don't see as much of that. We sometimes see it indirectly. What's interesting with the Chinese whales, they often are trading and they'll buy back somewhere, right? Whereas the whale that we executed, I would be very surprised if that money ever comes back into the system. That was a one-off. Someone got lucky and bought a whole bunch a long time ago and decided to take profits and have a new life. I wish I could answer the question. I do feel a lot of it. People had plenty of time if you were going to get out. And if you've held it back to here, I was actually talking to a guy who's got a huge stack. And he's like, yeah, maybe I should have sold something at 120. I didn't, but I'm not going to sell it here on the next leg up, even if it's a 4-year cycle. That's when he'll sell something. And so as long as crypto doesn't fall below 70, like if Bitcoin got below 70, maybe people shit their pants and get nervous that, oh my God, I got it. But I don't think you see selling in the mid to low 80s from long-term holders.
Speaking about these long-term holders, another way in which they have potentially been generating yield and cash from their holdings. And I don't know if you've also seen this from your end at Galaxy on the desks there, but this theory has been propagated by the guys over at Bitwise. I think it was Matt Hogan and Jeff Park more recently, is OGs basically selling covered calls. Yeah.
That's going to continue to happen. It's just going to continue to happen. There's, listen, vol's down a lot. You don't get paid nearly what you used to get paid for it. But there is a mindset that that's a nice way to make income, to spend it on my car or my boat or whatever I need to spend it on. And so that's become almost a permanent feature, I would say. And that'll weigh on the market some.
And then what about, coming back to a point you made around the momentum of these markets, and I think for someone who has worked in TradFi, myself and you as well, you'll know that momentum is a very important factor. It's easy to sell things to invest to asset allocators when things are going higher, and it's easier to sell when those things are going lower. And momentum is a very big factor when it comes to asset allocation in general in these factor models. Right now, in terms of this year, crypto has not been a momentum asset.
No, compared to
yeah, like with that factor now weighing on it, how long? What do you think is going to make the
I
switch?
mean, that's not true, right? That's not true at all. That's not true at all. Look at these crazy moves we got. Could have shorted this whole thing down, long the whole thing up, and then got another massive move down. That's amazing. Two directional momentum. What more could you want? People are faded.
And again, beyond just, and how, what mind shift needs to happen for them to think about, okay, so maybe I should be allocating again to crypto, even though it has been underperforming. Or do we need that performance first before they'll consider allocating again?
In the short run, I think if I was a big institution, I'm waiting for it to get back above 100 than buying at 87, unless it really goes lower. And so it's time. But you also, like, crypto is always sold. To sell something, I need a story. So the story's got to be, if it's Bitcoin, it's got to be about liquidity. And so let's wait to see the new Fed chair. Let's wait to see what he talks about where rates are going. Let's wait to see what the US Fed does with, you can make a story where they make Fannie and Freddie risk-free assets. Well, that would add trillions of dollars or hundreds of billions of dollars to, liquidity in the banks. One thing, Trump and Bessent and whoever he picks to run the Fed, once markets higher, they want the US to continue to be able to fund its deficit. They're going to print money. When that story picks up again is probably when you see the next leg. And then the momentum, like on a chart now, it would be, get us back through 100. I thought wrongly that in the next 2 weeks, we were going to grind up to 97, 98, 99 and kind of stall there, maybe even 102. Now the chart tells you, doesn't look so good. We could stay here, we could bounce, but you really got to get above 95 level to even have a shot at getting up to 100, 102. If you're a trader and you sold it, your stop loss is 95. We've learned in crypto, one giant buyer can change things quickly. And the markets are not that liquid right now. If someone came in and wanted to buy $2 billion, we'd be above 90 in about 15 seconds.
That's true. I mean, one of the biggest buyers coming back to on the selling side has been the OGs, but on the buying side, that's been a big factor earlier in this year has been the DATs and strategy.
I would say DATs are dead. There's going to take some time to figure out what becomes of them. Some are trading at 30% discounts. We were having this conversation today. What do you do with the one that's trading at a 30% discount or a 40% discount? Well, you can buy their stock and sell your Bitcoin, put the trade on yourself. They can do that. And at one point, some of these DATs will transform themselves into really cool new businesses, right? It's permanent capital. You've got capital, you might as well do something with it in that space. They're not going to be just ETFs. Like Michael Saylor created this ETF-like structure that traded at a premium, and then he became yield on it. And, I always thought he was unique in that he became a crypto himself. When everyone tried to copy it, you don't have the capacity to do that. And so now you've got, I don't care if it's Nakamoto or Pump's DAT or Vivek's DAT, all of them are going to trade at big discounts. I don't think they weigh on crypto anymore, though they could weigh some because someone could buy the stock and sell the underlying. But they're not going to be a way money comes into the system anymore, right? Retail got burned. That's been one of the reasons we're down is we lost our buyer. DATs were the buyer. We lost the buyer. The next buyer is going to just be the continued trickle of wealth, right? If you look at JP Morgan or Bank of America or any of these big wealth platforms, right, that have the RIAs. Remember, we have about $45 trillion of wealth managed from the baby boomers. It's managed by stockbrokers in the old days, we call them, right? Now they're called registered investment advisors. If they move to 3% allocation to crypto, that's $1.2 trillion. 5% allocation is $2 trillion. Like the whole market cap of Bitcoin is what? 1.7 trillion? As wealth starts to allocate, it dwarfs everything else. And that's just starting.
No, that's a fair point. And like the old guard is falling. Like Vanguard recently allowed this, and we've seen all these incredible structured products that have come from the likes of Goldman, Bank of America, and
so that will continue to happen. Again, once the market structure bill passes, it makes Wall Street even more crypto friendly. Wall Street is a selling machine. It was set up. I live down here. It was set up and built to sell stuff. Right?
Exactly.
We're raising capital by selling it to people. It's the greatest selling machine the planet ever created. Now you're going to put Bitcoin and other digital assets through that selling machine. I usually bet on Wall Street.
Yeah, no, that's true. We'll get onto that in a bit. I just want to come back to the DATS point, because you said they did, and that's fair. And I think many people can confirm that, at least the marginal DATS. But there is all this FUD around strategy. And it always seems to crop up, around a bull market or around a bear market when we go into bear market.
Michael's very smart. He believes everything he says. It was a very thoughtful idea that they came up with, sanctioned by the board, to say, hey, let's put at least enough cash in a reserve to take off the run of the bank for the next couple of years. And I think that calmed things down. Can he get the stock trading at a premium again? We'll see. I think it's trading about 95 cents on the dollar right now. And when it trades below par, below NAV, for a while, it drifts into the category of just another closed-end fund. It doesn't do anything bad for the system, right? We have closed-end funds in every product in the financial services. It just becomes less exciting. Why it's important for Bitcoin is he was the number one salesman for Bitcoin, right? He was the community salesman. He was the face of the story. He's very articulate. He's very animated and excited about it. And so if his platform becomes dull, right? Strategy trades at a 15% discount permanently. There's just less energy of bringing people into the tent. In some ways, it's always time to find the new salesman. I was willing to retire a few years ago because I was laughing. I said, I've told the story of Bitcoin so many times, people are sick of hearing from me. You got to have a new generation of people that are bringing people into the tent. Larry Fink did the best job of it, right? Because his platform was the biggest. The community needs to constantly refresh itself. The story doesn't change, right? And keeping the story simple, but new generations, new avenues of bringing people into Bitcoin. In some ways, it is a game of building trust with your fellow citizens, your fellow people in your community, right? It's the value of Bitcoin comes from the social construct that me and you both agree it has value. If you're Crash, you could call it a multi-level marketing machine. I sell it, you sell it. If everyone stops selling Bitcoin, let me tell you what the price happens. It goes down. All of these ecosystems need energy. What's been fascinating is how many of them have been able to keep energy. What is energy? Energy is how do I bring eyeballs to the story? So you need, Bitcoin would not have existed without Twitter, right?
Really?
Bitcoin would not have existed without Twitter. Twitter gave it a platform to tell its story. This is a storytelling asset.
That's
right?
that's so true.
Yeah, think about guys like Brock Pierce, where he was walking around handing people Bitcoins, telling the story. You think about all the OG storytellers. They all deserve a pat on the back for the work they did, pushing the ball forward. Dan Morehead probably did more institutional talks on Bitcoin than any man that ever walked the planet. But it was, there are hundreds of them and thousands of them, quite frankly. And then someone in every small village was telling that story. That's what makes crypto valuable. It's the community. We're transitioning. Now utility is going to be much more important. Not just in reality, but for the story. Because now that blockchains are fast enough to be used, the legislative framework's allowing them to be used. People are like, okay, what does it do? Show me how it works. And so it's going to be harder for blockchains that don't do a lot. And we have a lot of ghost chains with high valuation to keep their story alive, right? No story, no value.
Yeah, that's true. I guess, do you think that, and this is why many people just get into these philosophical debates around Bitcoin's original purpose, right? Born out of crisis in 2008 caused by bankers with the subprime mortgage crisis and, forced cypherpunks. And now it's basically just been wrapped in an ETF over at BlackRock for Larry Fink to shill. And what do you say to that kind of argument? Because admittedly, there's also been, I've seen it on the timeline, some people think, okay, maybe this is part of the reason why some of these OGs may be looking to cash out. Obviously, they're going to sit on massive gains. But I guess that argument that the original ideals of Bitcoin around its purpose as a nascent currency that's outside of the financial system is now basically being co-opted by it.
When I think of what Bitcoin has morphed into standing for is a hedge versus the unbelievably irresponsible fiscal and monetary policy that the West has engaged in. And that happens in every cycle. That happens. Every reserve currency blows it. They print too many dollars and you debase the dollar. It had energy of the system because of what happened in 08. The system's not fair. We wouldn't have our own place to store our wealth. But it really still is a store of wealth. I'm trusting this community to store my wealth because I don't trust the Federal Reserve. I don't trust the U.S. government won't keep. Donald Trump's never liked a tax he wouldn't pay, right? He loved debt his whole career. And so why do we think now they're going to get responsible? And they're not. Right? The deficit's bigger now than when they took over, or just as big. We're at $38 trillion in debt. We're going to be at $40 trillion in debt. And so that's really the story of Bitcoin. And I don't know if it matters if you keep it, on your Trezor, in your safe in your garage, or if you keep it in custody at Fidelity. You're buying it for that same reason, really, because you think the dollar's going to be worth less. I was looking this morning in here, where's my gold? I got a drawer full of gold coins. And I was like, shit, I gotta get a safe, because when I bought them, they were all worth like $1,200, and now they're worth $4,000 or $4,300. And I got 50 coins in there. And I was like, it was the same reason. And we were digital gold. And I think getting away from that story makes it complicated. And yes, it started, Satoshi thought it was going to be, going to be money. Well, money you can confuse as store of value or a payment system. I don't think it was ever meant to buy your Coca-Cola.
No, that's fair, to be honest. I mean, as a store of wealth, long-term store of wealth, and as a dollar as a dollar gets continually debased, I think there's nothing really that can compete with Bitcoin. Even if gold is, performing well now and outperforming to Peter Schiff's delight, I still think that Bitcoin is the ultimate store of value. Just coming back to, when you mentioned now, of course, the debasement of the dollar, the massive deficit spending, the proverbial nothing stops this train. Yeah, and you mentioned this earlier in terms of macro for next year as it relates to Fed policy. So we had the FOMC last week. We had rates were cut, but we've also had the restarting of, albeit limited QE to the front end of the curve. And now it seems as if we're in a horse race between the two Kevins. So I guess, how are you reading the macro tea leaves from that perspective? And do you think that we are going to get this mass 2008-esque QE that many people seem to be hoping for beginning next year, like just mass liquidity into the system?
I think they're going to cut rates. I think jobs are a bigger worry in the administration than the market has them, right? This idea that AI is hitting jobs, I think, is real. And so watch non-farm tomorrow. But as long as you have job weakness, you're going to have a very dovish Fed. It doesn't matter what Kevin. I know the market perceives Kevin Warsh is going to be more hawkish. He's not. He wants rates down at 2.5%. That, I think, is a good story. Do they do QE? I think probably more likely with Hassett than with Warsh. I think the first chapter doesn't matter because it's just getting rates down. And I think what's also going to see is they're going to allow banks, you already did this, to get more levered up. I said, if you take Fannie and Freddie and make them risk-free assets, it's trillions of dollars of liquidity, or hundreds of billions of dollars of liquidity. I should know the number. What do banks hold on their balance sheet in mortgages? And if those become risk-free? And so you're already, they did this thing with the SLR, which is giving banks a lot more liquidity. And so you're already jamming liquidity. I think it'll start after the new year, right? Because right now there's year-end liquidity. Liquidity gets tight as people want to clean up their balance sheets just for the snapshot. And so I do think we're going to be in a hyper-liquid space.
That's positive. So Q1. You got
to have the yield curve steepener on. You got to be long 2 years, but short 10 years, because that should be a good environment for gold, silver, Bitcoin. Right now, silver's the horse in the front of the race. Normally, when you get close to the end of the year, the horse in the front of the race wins. You got to bet silver and gold outperform Bitcoin in the next 2 weeks. But next year, you get a new race.
That's true. I mean, it comes back to, if, like you've said many times, you think Trump is going to juice the economy, run it hot, bring rates down. QE is obviously going to, inflation expectations probably going to go up. Long ends are going to, long end bonds are going to sell off, and then, the debasement continues, right, in that environment. So it is interesting. I guess that if inflation starts, if the end result of this is a resurgence in inflation, isn't that potentially bearish for the economy itself? Because you've got the whole K-shaped economy. People who are in the lower rungs of society are struggling with, cost pressures and stuff like that. I mean,
okay, I'd like to take a moment to thank the sponsors who make this show possible. SVM's ecosystem has been you trade.
Is this necessarily the best route the Fed should be taking? I mean, obviously it's good for people in the markets if you hold assets, if you hold Bitcoin, but is this, if you were like the Fed governor, would you be juicing the economy? Would you be dropping rates?
The $79,000 question, is AI going to be the greatest productivity enhancer and hence deflationary force we've seen? And if it is, rates should be a lot lower, and you should be juicing the economy because you're going to be losing jobs. I actually think I see no way out in the long run without us getting to UBI, to some redistribution of wealth, right? The real risk to the country and actually the global economy is the inequality gap gets worse every day. And technology is allowing fewer and fewer people to make more and more of the money, even in finance, right? It used to be the Goldman Sachs of the world that made money. Now it's Jump and Jane Street and Hudson River Trading and Susquehanna. I don't know if you saw Hudson River Trading's last quarter. I think they reported $4 billion in profit. We're in the same building as Jane Street. It won't shock me if they make another $20 billion this year. Billion. These are companies with 2,000, 1,500, 3,000 employees with a couple partners. We've never in my lifetime, and I've been in this Wall Street, I'm 61, so a long goddamn time. I've never seen wealth creation like I'm seeing now in these private companies that no one knows about. In the entire time I've been in this. And so why are they able to do it? There's this confluence of events that are happening, right? On the one hand, we have a whole new generation of gamblers, and you can call them investors or gamblers. And it's same day options, it's meme coins, it's parlay bets on sports betting. It's young kids that are saying, hey, it's hard to buy a house. I enjoy this. I can make money on it. Whatever their reason is, we've made speculating cool. When I was a kid, you could only gamble at Las Vegas and Atlantic City, and there were seedy places. It was illegal to bet on sports, right? Gambling was very taboo. I make this joke. I was like, I got a chef who's a same-day options guru, a son-in-law who's a meme coin genius. My son, he loves parlays on sports betting. Like everybody in that 20 to 30, every male in that 20 to 30-year-old range is engaged with friends in some form of speculating. I'm telling you, when I was 20 to 30, that didn't happen. Maybe if you worked on Wall Street with your PA, you'd buy a stock. But none of us were speculating. We were working, trying to make money. We might have had a job trading, but not on our PA. It's a whole cultural shift. And so I'm not sure it's a good one, but why is Jane and those guys making money? Because they're taking advantage of all that inefficient liquidity.
Very interesting way of looking at it. I mean, so essentially, these highly sophisticated private firms are making money off of retail who are trying to beat the market in some way.
Yes.
But then it's like they're in a situation where if they're not beating the market, I mean, they're trying to, they have this hope that they can. But then in terms of the real economy, there's not that many jobs then because AI is replacing jobs, if that's the notion. So is it just to try their luck in a dystopian way to make it 100x on a 0-day option or a meme coin or whatever it is?
Yes, and yes. That's why if you're like a Republican, you said, you know what? As long as everybody knows what they're doing, buyer beware, right? And if you're a Democrat, traditionally, you're like, hey, that's not good. Are these guys adding to society, or should we put a transaction tax on them? And you're going to see these conversations come up because this story is going to get, it's too big of a story. There's too much money. In India.
No, this gambling stuff cannot be good, right? This like sports gambling and all this shit. It cannot be like a net positive. There's just too many dumbasses, right? Everyone thinks they know everything. And they're probably just pissing away their money day after day.
And I talked to some Indians. They're like, it felt like the East India Tea Company, right? A bunch of smart guys. These guys were breaking the rules. Well, let's say they weren't even breaking the rules. Smart guys coming into our markets, taking a ton of money and going home with it. Like, what does it do for us? And this is where you're going to see this populism show up. Like, is this fair? You can look at fair from two ways. If everyone's playing by the rules, one person says, well, of course it's fair. Here's the rules. We just played by them. Don't get mad at me that I'm faster than you or smarter than you or quicker than you. Another could say, yeah, we have a set of rules, but if the same guy wins every time, we don't like the distribution of there, so we're going to change the rules, right? Because it doesn't seem fair that one guy's going to have all the money at the end of the year. And so we're going to have this real debate, I think, publicly, politically, not just in the US, globally, about globalization and technology. And when Elon Musk is going to be a trillionaire in the next 18 months, and that's higher than 60% of the wealth of the rest of the United States combined, it just doesn't feel right to people. And so that's the biggest risk to markets is the political backlash. The wealth tax that's coming. I don't know if it will come in the form of a wealth tax, but some form of wealth tax always happens historically when one group of people make all the money.
This is a very good point in terms of, especially if, look at the inequality going on now. And this is what Ray Dalio talks a lot about in terms of the end of society generally. And many people could argue, are we in the late stages of capitalism, last stages of late stage capitalism? How do you think this plays out then next year? Because I mean, this is obviously informant in terms of what potentially crypto markets could go, but like.
So I was with Ray last week. We had this debate, just two of us. In the long run, he's going to be right. And you don't know in the short run. AI is a bubble. And my guess is it's going to become the greatest bubble of all time. It's such a powerful story that when you call a bubble, it usually is 2 years early. And he doesn't know the timing either. And we also don't know the timing of politics, right? We've got Mandami, who represents a really smart guy who looked at the system and says, hey, things don't feel like they make sense. And a whole group of people feel like they're falling behind. There's another part of the Democratic Party in America, Mickey Sherrill in New Jersey, Abigail Spanberger, who just won the governorship in Virginia, Josh Stein, who says, hey, there's a middle route Democrats, most Americans resonate with, right? It's not socialism, it's capitalism. But we've got to actually understand, we've got to deliver things to make standard of living higher. But it's hard when you bring the inequality into it. I think in the long run, you have to redistribute income much more efficiently than we have in the past. And that's about the best you can do. Like, we already redistribute income a lot in the US and in almost every Western society. We just don't do it efficiently. But it's going to have to be some form of that.
Especially with state capture going on nowadays, you see. So then the next year, you've mentioned like the momentum, and some of these Democrats have come into power through their moderate views, and this plays into what happens next year. How do you read the political landscape then? Like, what do you think is going to happen?
Yeah, I think unless something dramatically changes, the Republicans are in big trouble in the midterms. Now, what does that mean? That means Trump's a political animal. He's going to do everything he can to juice that economy so he doesn't lose these midterms. And that's where I think the juice theory comes in. But I think if you lose the midterms, that might end the cycle in the equity market.
To the juice box.
AI is powerful, but it's going to stop the effectiveness of this administration. And they're going to maybe, believe it or not, even be more erratic because the Democrats are going to try to impeach Trump, and that whole horseshit back and forth starts again as we're going to an election cycle where Trump can't run.
That's going to be crazy. It's going to get messy.
Yeah. I think from crypto's perspective, why it is so freaking important to get market structure done now. The Democrats want crypto off the table as an issue because right now it's a Republican winning issue. All the crypto money, or most of it, goes to Republicans. And it is both perceived and now seen as real that crypto had a big impact on the election of getting Trump and everyone elected. From a Democrat perspective, they say, hey, let's pass this legislation so there's nothing else to talk about. Let's make crypto bipartisan, which is great for crypto. So we'll see if this thing gets done. I hope it does.
Yeah, I mean, I think it's now been pushed back to the beginning of New Year. I think they've been back and forth, and someone in the White House doesn't like the conflict of interest kind of like wording.
What did they say? It was what's his face? That David Sachs guy was saying that they're looking to table it again in January, but who knows?
But
Especially if there's another shutdown, which seems like there might be.
how do you think the markets? Where do you think we would have been now in terms of the crypto space, Bitcoin, etc., if Kamala had won?
Yeah, it's hard to say. I think you would have still passed legislation. You wouldn't have near the support at SEC. It's not just the legislation getting passed. That was getting some momentum. Paul Atkins is a radical. He's like, put it all on chain. And so the acceleration of digital assets as a force for good, I think would have been much slower under a Democratic regime. We haven't seen the gains from the OCC's change of heart or from the SEC's change of heart, the CFTC's change of hearts. That'll come in the next 2 years, right? And those gains are going to come from TradeFi participation. They're going to come from, I mean, think about just even prediction markets. Right now, prediction markets are a hype, but pretty soon you're going to be built into everything. And that's all because of the CFTC ruling, right? And so I think the Trump impact on our business, or the Trump administration impact on our business, probably starts now and really ramps for 3 years.
Yeah, and one of the big beneficiaries from this change, especially as it relates to new token issuance, tokenization on chain to stablecoins, is altcoins, right? But it's quite clear that the the experience of people who've been holding altcoins or altcoins in general, as compared to Bitcoin this year, has been quite clear.
Altcoins have sucked because they were designed to suck. People were.
I mean, probably the best way to say it, realistically. Like, if someone puts a gun to your head right now and tells you to name fucking 20 altcoins that are going to survive this cycle, it might as well just fucking shoot you, right? Because you're not going to be able to answer. Like, aside from, like, ETH, Solana, Binance, and, like, what else? Like, Link. Everything's basically fucking going to zero, right? Most likely. Like, maybe, like, Sui makes it. Like, Hyperliquid. After that, it's looking pretty fucking grim. And even that list is not guaranteed.
So scared of giving any utility or any economic interest being deemed a security token that all the altcoins did, generally speaking, were represent, it was like, hey, you get to be part of my energy. They were community tokens. So they're all a version of Bitcoin with very different stories. Like, we were big investors in Celestia. It's a very good piece of technology, right? The first modular blockchain, smart guys built it. Look at the chart, and it looks like so many others. Why? Because you don't get, there was no economics that came through the usage of that to the token holder. Again, why I keep going back to Hyperliquid, I think as the ideal token. But Hyperliquid under the Gensler administration would be a security token, right? And so getting these rules set in this new piece of legislation that allows people to create tokens that give some economic value to the user of the token, as opposed to just, hey, look, it's another version of Bitcoin, will be the radical thing that happens. And if it doesn't happen, our industry is going to suck.
This is so true. So it's like the products, the altcoins and the networks that are actually thinking of ways to generate revenue. Like, you view it out like a cash, like value of business, right?
Pump.fund is a fine token. He'll either pull it off and be a platform where people keep using it. Does he switch to TikTok and monetize attention on videos? Like, smart team, but the way their token is set up is fair.
It's fair. Just coming back to the underperformance, that's a good point you raise in terms of the actual incentive to hold the tokens. But there's a few other arguments I've seen around. One is potentially dilution of all these altcoins out there in the space. We've had a lot of unlocks, and now we've got like 10 different layer ones, 20 different layer twos. So there's dilution argument. And then the other argument is, well, retail has a lot of opportunity, or people have a lot of opportunity to, if altcoins are generally held as a beta on Bitcoin, there's a lot of other ways to get higher risk allocation to Bitcoin. Like, you have ETF options, you've got leverage trades, and now you've got like the likes of options on, in Robinhood and all that, and AI. So do you think that this is potentially taken away?
Yeah, but like the average person that was buying fucking altcoins is not going to be some like well-informed options trader, right? They're just fucking buying spot and hoping it went up 20x and just got fucking rich doing nothing. It doesn't apply to them.
The intention for retail to invest in altcoins, and then do you think that the dilution is having an impact on the ability
I think,
for
first
altcoins
of all,
to move?
no matter what you're trading, I've been doing this for 40 years, kernel of truth. What you're trading, it's always who's buying, who's selling. What are the flows? And you could make a fortune in any asset if you knew the flows. So I've got a guy, one of the best hedge fund managers in the world. All he does, he's got a 20-person team that measures flows, seasonal flows, where the flows come in every asset, in wheat and gold. And why is gold up? Because central banks and Tether have been buying it. They've been dominating the flows, right? And so when you have these giant unlocks coming, that's sellers with no new buyers. The price is going to go down. It's like third grade lessons in trading. And if you were disciplined to just sell before the unlocks, you made money. Once in a while, there's such a great hype story that it takes you out. but almost never. And quite frankly, why the highest market cap blockchains are the oldest, other than Hyperliquid, quite frankly, is the only one that's kind of broken into the top 20, is because they got distributed well, right? So there wasn't this constant sell pressure.
No, that's fair. You've mentioned Hyperliquid now. I believe Galaxy, in terms of the firm, was involved in a lot of the Solana DATs. So I assume you're also still bullish on Solana. Like, what are the altcoins in the top?
Yeah, full disclosure, I run the balance sheet for the firm, and we keep Bitcoin, Ethereum, Solana, and Hyperliquid as kind of our four horsemen. I always wanted to be a gold company that owned gold, not a gold company that didn't own gold. We debate this all the time, right? Should you just have a balance sheet, or should you trade the balance sheet like it's a hedge fund? And so, but we run ourselves to some index, but we basically stay long crypto. So, when crypto goes down, it sucks. When crypto goes up, it's great. It's hard to break into that top. Hyperliquid was the only new one that broke in, right? Before the year started was 3. It doesn't mean we don't trade other things. We'll be long coins, and we have a big venture portfolio, and use that venture portfolio when it runs its course. We book our profits and move on, and that's been the philosophy here. We've probably made more money selling than buying, if you think about it, right? Getting out of stuff.
You've said multiple times recently that we've moved from narratives to plumbing. So I'm curious then, if that is, what is the single most important piece of crypto plumbing that you think is still missing in your view?
I say we're moving, right, from narratives to plumbing. If you think about tokenized equities for a second, no one knows where they're allowed to trade yet, right? We're working with the SEC right now on getting those sandbox exemption to have our Galaxy digitalized token, which we tokenize on Solidus Superstate, to actually be able to trade on AMMs. And so at one point, the rules have to be more clear that, hey, tokenized real world assets can trade on X. Or the big debate on this market structure bill in DC is around DeFi. Should tokenized assets be able to trade on DeFi? Should Galaxy stock tokenized? Is that fair? You saw Ken Griffin from Citadel said, no, that's not fair. We have all this regulatory headache we put up with, and those guys get to hack that. I mean, it's a little bit like what Kalshi and Polymarket are doing to the casinos and the sports betting. And so the lobbyists down in DC right now against prediction markets are all casino people and sports betting people. And so we'll see how that plays out. But I think getting those rules clear is really important on where these things will trade and can trade. And that'll start the connectivity, right? The other piece is TradeFi is slowly getting connected. I say this all the time. I think Bank of New York will probably be the largest custodian in crypto. When people look at me like, really? I was like, yeah, because they're the largest custodian in everything else. And so TradeFi really believes that as we digitalize or tokenize all assets, like their whole business is going to be tokenized. They might not trade all in tokenized form, right? The US equity market's pretty efficient. This is a big transition coming.
Looking forward. I mean, yeah, we just need those regulations. We just need the actual frameworks to be able to build out in this. Just quickly moving on to some final questions. Yeah, I wanted to move on to just some of your experience, if you can impart on our viewers, in terms of you've been an investor for a long time and no doubt faced lots of challenges, ups and downs, and no doubt you've come out on top. And you've been in crypto for quite some time, right? Like I said in the beginning, in the intro, you're an OG. What's your advice for those who are in their crypto journey right now to have that staying power, that long-term vision and optimism?
The number one rule of investing is don't die. And it sounds like a stupid rule, but it's, when you're down on, don't die, don't quit. And which means don't be stupid. Don't bet everything. Have stop losses. Don't just keep doubling up. Shit can go further down than you think, and it can go further up than you think. When something's on a moonshot, take some profits, take a little bit more. Don't take 70%, 15% off, 50. Like scale out unless it's your one really core position bet, right? You can't have 19 highly held convicted things. It just doesn't work that way. Figure out what your rhythm is. But like in 2008, we got close to dying. And I remember my partner, Wes Eden, said, guys, we got a couple hard decisions to make. And if we swim this way and the current pulls us, we're going to miss the boat. So we got to look at where the current, let's be really thoughtful of those decisions, because that was a crisis. And we luckily, got to the safety raft. But the mindset was don't die, because you can always come back. If you lose all your capital, you're pretty much dead. It's not just capital when you're a young kid because you can get a job, but it's your reputational capital, your confidence. That's it. Listen, everyone's not meant to be an investor, right? This is a hard job. So this idea of the democratization of finance, in some ways I always thought was horseshit. I thought everyone should have equal access to investing opportunities. I made a fortune on SpaceX, I'm just looking at it now, like a bizarre fortune. I invested in SpaceX in 2013. I'm telling you, if I'd come on a podcast, I would have told people why I invested in SpaceX, and every one of your listeners would have said, I'll do some of that. They didn't have the access and they didn't have the capital, right? You had to have, it was a special purpose vehicle by appointment only. You got lucky to get into it, and now it's 100x, right? You saw Google's going to have made their largest win of all time because they put 800 million into SpaceX, and it's going to be worth like 800 billion or something. I mean, some crazy number.
Yeah, no, it makes sense. So definitely, yeah, it's kind of like Squid Games, crypto investing or investing in general. If you get once you're out, you're out. and you don't die. And he who chases two rabbits catches none. You can't have multiple different positions. I think there are many people in crypto, they just hold people who hold 20 different positions and sparsely allocate, and it's just, you're not going to make it big like that. That's my personal view. Just another quick question: what moment convinced you? Because obviously, I say you got a TradFi background, and prior to that, what moment in crypto made you realize that crypto would end up being your life's work?
I walked into Joe Lubin's office. Joe was my college roommate. He was a co-founder of Ethereum. The Ethereum project had just launched. I hadn't even heard of it. I knew Ethereum because he had told me he was working on it. I met Vitalik a couple years early. I went to see Joe, and I thought he'd have an office with one person in it, and a dog, maybe a cat. And I walked in, and there were 24. Andrew Keys was in there. There were 24 hard-charging people. And Ethereum was trading at 96 cents. But I was more impressed with the energy. And these guys talked about this as a revolution, how they were going to go after each sector of society and disrupt it. If it was the music business or the finance or lending or ticketing, and how this decentralized peer-to-peer revolution was going to take what Bitcoin had done on money and do it on everything. It dawned on me right then that this was going to be something bigger than just speculative. There was an energy of those people that felt like a revolution. And then I started looking into it and thinking about it. We had never had a global revolution in finance, right? We had it in global markets. Crypto was like the first global market that exists, right? You could always have traded gold, but most people didn't trade gold in currencies, but Americans don't trade currencies. And so you have a Japanese bond market, US bond market. Now we're taking assets in the whole world. Bitcoin is bought and sold in 204 countries. It's got the biggest, broadest distribution. And I thought global, young, and with passion. And so that's kind of when I said, hey, I should spend a little more time in this thing. Bought some Ethereum at 96 cents. That was a good buy. Some
Mega
lucky
juice.
life. I bought Bitcoin at 100 and Ethereum at 96 cents. No one should be surprised I made money. Good entry points.
It's interesting as well, because I think many people, you bought in those early stages, but many people who says, oh, if I wish I could go back and hold and buy Bitcoin when it was just coming out, or 2013, 2015, I could buy Ethereum in the ICO, I would be so rich right now. But it's hard, because in benefit in hindsight, in that moment.
They all fell. And so here's my other dirty secret. I was already rich, and really rich, not just a little rich. And so when I bought Bitcoin at 100, I bought a lot of it, but it was less than 1% of my net worth. And when I bought Ethereum, I bought a lot of it, but it was less than 1% of my net worth. And it made it easier to hold it. The other part that made it easier to hold it is I became publicly associated with it. I never asked to be a Bitcoin spokesman. I was actually talking about it. I didn't know the press was there. Next thing you know, the press was there. And then I got invited to speak everywhere. And so once you're public, you feel like a different ownership. It also forced me to understand it better. Like I literally got invited to speak at the Oxford Union and then on the Sohn conference on Bitcoin, these big platforms. And I'm like, I don't even know how this thing works. And so I did my digging, and it was trying, at that point, it was the Byzantine generals, paradigm and double spend problem and all these computer science ideas that were breakthroughs. I didn't know what a consumer computer science breakthrough was and why it was so interesting. And so I boiled it down to this really simple sentence. Bitcoin was the first digital asset you couldn't counterfeit. You couldn't go control, copy, paste. And that made it private property. And I knew from being an economist or studying economics, private property is the key to capitalism, right? It's the foundation of capitalism. It's the key to freedom. George Washington once said that. Private property, there's no freedom. Every emerging market country that gets property title rights, they boom. And so I was like, there was something cool in that this is going to be the first private property on the internet. And I think that's probably still the premise for why this decentralized revolution has a great chance of helping to kind of rewrite how finance and consumer behavior happens in the world, because we now can have ownership in a digital form that transfers from me to you, and is preserved. I mean, I've told the story. Gaddafi, when he took over Libya, took all the titles and burned them and said, hey, all your property is fucking mine. Well, if it's on the blockchain, no, it's not. It says it right there. It's mine. There were so many things that resonated with me from that simple insight that I was like, this is going to be cool. Now, I would tell you what, I will be really disappointed if in 10 years, crypto is still mostly Bitcoin, stable coins, and a bunch of gambling tokens with 25 to 30 to 1 leverage. Like, I really want it to work. And I think it's going to work better and faster overseas than in the US. If you think about what a crypto wallet is, it's a personal finance. It's a bank. You should have your interest, your stable coins, your money market funds, your equities, your crypto, your opera tickets, all in a self-custodied, or if you have too much, some self-custodied and some custodied somewhere else. That's revolutionary. So I think it's a bigger idea for the rest of the world than it is for the developed world, but it's a big idea.
Yeah, no doubt. And you need important
That's
spokespeople for
true.
the space to tell that story, to bring that energy. And you've been, been holding that baton.
People
for many years
underestimate the
now, so
impact of
that's
stable coins and
testament to
whatnot
your
in like
dedication to the space.
other
I think it's
developing
important, like you mentioned at the
regions.
beginning, we need to pass that baton on to the next generation of people who are willing to tell that story.
I had hair like yours when I started.
Yeah, I mean, well, I guess like my longevity in crypto, I question it many days in terms of how quickly I'm going to age. But I think that, it's that important point around having the perspective of what it can do for financial freedom, especially in the rest of the world, in countries that the story that you hear about is, like we talk about, TradFi's adopting it, BlackRock's adopting it, but the people who actually, the real adoption that matters is those in the likes of Africa and Asia who need to finance like imports, and they use Bitcoin or Tether, or they say they haven't had access to a bank account and they're able to do that. And I think that none of that story is told. So yeah, that's why I think we should remain optimistic about the space in general. But thanks a lot for this, Mike. I mean, I wish it could have been longer, but
All right, enough of that. Enough of that. Boom, 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 boom. Might as well delete this box, y'all. It's already fucking going. I mean, these charts, right? Like, a little alarming. Little alarming. Things are all like fucking already doing blow off tops. Interesting. Yeah. President Trump will be making major announcements with War Secretary and the Navy Secretary at 4:30 p.m. Interesting. Interesting. They say Trump might get impeached. I suppose it's possible. But it wouldn't be the first time they tried. Not be the first time. Is it gonna be like all fake news again? Like, is it me, or is it fucking crazy that that whole Russia hoax was made up and like nobody got in trouble for that? Like, can someone fucking explain that to me? Someone fucking explain that. Like, how did that just conveniently get forgotten in the sands of time, right? Make up this massive fucking hoax, go on and on and on and on and on about it non-stop in the news, and just all of it's just fucking made up bullshit and never mentioned again. Actually ridiculous. %, of the shit they threw at him was bullshit. I dislike the dude, but the libs are criminals. Yeah, pretty absurd, right? Pretty absurd. I mean, whatever. I'm sure it goes both ways. Like, maybe not in this specific like set of presidential campaigns, whatnot, but I imagine like both sides have done the same thing in the past. And then like the whole hiding of the Hunter Biden stuff, I think that's also ridiculous, right? Like, can we be fucking on? Can we be serious here for a second? Like, clearly like, engaging in massive legal activities with like actual proof. Just casually swept that under the rug as well. Of the entire media establishment. Yeah, exactly. Like, I forgot who was talking about it. I think it might have been Elon, maybe even. Or some person in tech, and they were doing an interview. And they were saying how like a big problem with this stuff had to do with the fact that all the tech companies work in San Francisco. And that's like a seemingly very left-leaning, like far left kind of ideology, always has been. So like when they were like developing Facebook and Twitter and whatnot, all the social medias essentially, all the employees of these companies were like of that mindset. And they thought it was normal because everyone that's where they live is the same way. I suppose it makes sense, right? The logic of it makes sense. Republican Thomas Macy just announced he's opening impeachment investigation against Pam Bondi for concealing Epstein files. I honestly don't understand why people have such an obsession with that. I really don't. Of Macy, who the hell? I don't even know who these people are. Dude, you just mentioned. No, I know that, but like I was just reading his thing. Like I don't know who that is. You love the cult of being a Republican. My ilk isn't a cult, few and far between. I mean, I think government intervention is alarming. Pretty funny. Like if you watch it, I can watch like I don't even know how many I've seen. Like tons and tons and tons and tons of podcasts with like CEOs, like real estate companies, tech companies, health companies, like whatever you name it, any company you want, right? Just the most successful people of all the different industries. And every single fucking one says the same thing in the US. It's just a waste. Government is incredibly fucking wasteful and impossible to work with. Not once I've heard someone come out and say, yeah, government's super well run and hella efficient. We'd be lost without them. Not once. Like even today, I was reading about those fires in California, like the Palisade fires and whatnot. Seems like the whole thing could have been avoided. I'm like, what was the other statistic I read about that stuff? So like every homeless person, I forgot what the number was, but every homeless person in California costs them like $1 million a year, or like, or an even shorter time span. I don't remember the exact window. But then there was this like private run company, like People of Hope or something, or like Shepherds of Hope. I don't remember what the name was. Something with hope in it. And apparently those people like take in homeless people and then put them into like a home, like a care home and whatnot, and get them off drugs and rehabilitated permanently for $100 a day. So quite the disconnect. Seriously about management. It's easy to knock the system. Anyone can do it. So I had to consider finding solutions to the problem. But you can't though, you can't. Well, what solution can you suggest if they're in control of the government, and then like, if you try to suggest anything that hurts their bottom line or their goals, they just put some like massive misinformation against you, blah blah blah, or like make it like impossible because there's so many like steps legally to get what you want to get done. And then if you do make it to some end goal, like then there's some like a judge that's gonna shut you down anyways. Water. It's called a conspiracy theory. I mean, is it though? We just witnessed it. We literally just witnessed it. With the whole world witnessed it with their own eyes. Like the whole thing with like the Trump like legal case in New York was ridiculous. It's like legal warfare. Change from the inside? You can't though, you can't. The people have tried to do that. Like who's this guy in California? 'Cause I was watching a podcast of him today. Some like real estate mogul. Or Rick Caruso. Tried to like run in California and like got shut down. You can petition too. Petition doesn't mean anything. Petitions are just an illusion, right? Do you really think they care that there's like 1,000 people outside of like the White House screaming whatever? Don't give a fuck. They don't give a fuck. Probably sitting there laughing at you. Like, look at these idiots wasting their day here doing nothing. That's what I think when I see them. Stick with your money. Pretty hard though, right? But the other thing to keep in mind is like the idea of like left or right is also like an illusion. Either way, there's like massive lobbying entities behind them. And no one's trying to, like, the way politics works is if you do anything that doesn't pander to the people, then you're not going to get reelected. So there's literally no incentive to do anything like away from that, right? At least in terms of the statistically. Like, obviously there's some wiggle room, but they like collect stats and all these things. But with third party. I don't even know what the third party is in Canada. What is the third legal party in Canada? Like third largest. The Quebec people. Interesting. Boom. Yeah, tough scenes. I don't even see how you get out of that kind of system, right? I don't see a way out. Because in reality, most people are uninformed on both sides. And it's more of just like a sports team than anything. Oh, everyone I know is like a liberal or democratic, therefore I'm just gonna go with the flow too. Or vice versa. So boom. And not only that, but like there's just like most of these people are literally delusional. Like in the face of all evidence, they'll just move the goalpost. Oh, but like what about this? But what about that? What about that? Oh well, even if that's true, what about this? oh yeah, but that's fake. It's not what actually happened. Like they never fucking stop, right? Just like a fucking endless chain. There's no convincing them. There's no reason. You can't reason with these people. Boom. What time is it? 11:30 almost. God damn. God damn. What do we do? Juice box, y'all. And get her going. Let's see if this ExoCharge data feed works again. All broken. Okay. Interesting. I had this blue box here to start the stream because there was like a bunch of like low time frame liquidity that ended like right there. I want to see if this like candle is gonna come up and tag it. We never ended up doing it. Oh, there's a lot of shorts that open here. There's also a lot of shorts that open here that didn't get closed out on this wick. So obviously their stop is like here, if not like higher, right? Or even higher. And these people are all like, we might be squeezing up here, to be honest. This could end up like actually finally squeezing up to the zone. I'm a little sussed out by this though. How's the order book looking? Can't I draw the box? Tricky. Tricky. Yeah, just keep these squeeze in mind, because as of now, like Spot has been buying into this kind of push. Like Spot is what's squeezing out the futures right now. But don't be surprised if we get this kind of thing, like we kind of squeeze up into market open, then like come back down, kind of sweep the weekend lows. So where's the RTH gap going to be right now? So we also have a massive gap below on our... Yeah, I keep this in mind, right? Like kind of like the RTH gap fill, if we still continue higher. Plus like sweeping the weekend like over like lows. And there's like liquidity grab here. If not, I'd be watching this zone, right? Maybe like an 886 tap. But like front run, because these spot orders are still down here, right? Like the remainder of the spot wall is still down here. But if we come down to this, I don't know. I don't know if that holds for a third time, right? Or like I guess it'd be a fourth time at this point. Kind of just put RTH a gap fill plus sweep weekend lows into the golden pocket liquidity grab just a single print clean. So how low is like the other gap? $355. So the gap fill is around this region, right? So kind of keep that in mind, like these two. Kind of put that as like a third, like potential 886 RTH gap fill plus the poor low. I'd be careful with this lower run rate. Be pretty careful. Yeah. Into the upside. Probably flipping the zone after the liquidity grab, right? At this kind of level. Like flipping the point of control, golden pocket region. After we clear like that just like a 90 cluster on like this red box. Let's just draw a little fib on there. We'll get rid of the smaller one now. We don't need this rate. Get rid of that one. We'll extend this one out a little bit. Okay. Yeah, like this zone basically, right? Either we're gonna like ding ding. Maybe we could like sort of like, realistically push through it, probably top this, then like back test this region where the POC was. Now, if we're gonna go finally for real, like it's probably gonna be something in this region that leads us there. Yeah, just be careful, right? Because we know how the New York sessions have been going for the past like month and a half now, and we know that right now there's like a pretty big squeeze setting up here, given how people are positioned. So it might be like another one of these days, where just like squeezes up and then comes right back down. We'll put it on there anyways. Just be mindful of what could potentially happen. Bullish retest of what should we call that? Like 91k basically. Who the hell is messaging me? Get rid of this thing. I mean, obviously, all these levels that we've been talking about have not changed, right? Let's kind of start off with that right away because that covers most of the shorts realistically. Our time frame plans haven't changed. Continues to be the case. I probably wouldn't be dabbling with this thing. Realistically. It's too big of a magnet right here, and almost certainly we're gonna blow through if we start to squeeze. So I don't think there's anything going on in the order book directly above us, right? There's like a big sell wall on 92, so like after like clearing this red box. There are some people here with like some TPs on the perps order book probably, or maybe they're looking to get filled on shorts. I don't know. A little suspicious to be taking a short there, I'd say. So I suspect they're just taking profit on something, but we don't know. But yeah, we wouldn't be surprised if we like slow down there for a bit. But if we do start to print some like higher time frame reversal up here, then like yeah, you can like kind of entertain it. But I would not like be like setting limits here ahead of time because you're probably gonna get most likely gonna get run over. And more often than not, you will get run over. So not the highest EV to be taking that like in that manner. Music stopped. Boom. Kind of leave that like that. To the downside. hard to say. And most likely it'd probably be like losing this zone, right? The thing is, you're gonna be a little late at that point, and also risk like this situation. So we do have an outside day. So like coming from here to here is like in the cards, you start to roll over. Well, also like trying to get in on a short like this down here is also like a little sus, given how like tight this is. Best bet is probably gonna be like this kind of retest, right? Or like this kind of retest. Maybe you can try and get in before this on the low time frame, but not a huge fan of that personally. Either that or like golden pocket retest. This is like what, 85.7? Yeah. Probably gonna be your best bet. If you want to get in on the move to down here, potentially those are probably gonna be your best bets. Because realistically, if you're taking these shorts, you're still in them, right? And if we do go higher first, then those are gonna be the juicy chances. Yeah, I should do it though. I should do it. How's everything else doing right now? And I'm just dicking around. Also be mindful of these gaps, right? We do have some gaps left on the indexes right now. I don't think there's too much going on in terms of the calendar. If I'm not mistaken. Yeah, like we have some data coming out on Tuesday, but tomorrow pretty dead. And Wednesday is like Christmas Eve, right? The unemployment, but like I think most of this week is gonna be like a write-off. So I won't be expecting too much crazy going on here. Yeah. We miss anything? Did we miss anything? 86.4. Looks like a pretty big high leverage liquidation like right here. Keep that in mind. Interesting. Okay. I should do it right. Kind of usual. Don't trade those things blindly. Make sure there's like data aligning when the price gets there. Not, don't take it. Don't got no edge. Don't take no trade. Okay. Do a quick chat shout out and get out of here, yeah. I still can't hear. I'm really deaf in my ear still. This thing is fucked. What kind of Christmas bullshit is this? Shout out to Dev. What else we got on here? It wasn't particularly active, right? I think it was just Dev and Lyle. Yeah, shout out to Lyle, shout out to Dev. I'll be back tomorrow. Might be the last stream. Might be the last stream. Maybe we stream Tuesday during the day. But we'll see. Yeah, to be determined. I haven't decided yet. But if it's not tomorrow, it's certainly the day after. I'm not going to be here on 24th. So we'll kind of keep being posted in the Discord for a while. Because I don't know when I'm going to be coming back. I don't have like a set time to come back yet. I have to be here in February, I think it is. Where's that thing? I don't recall. Like I have another one of those surgeries. I think it's in February. But I can't recall. Maybe it was in March. No, it's the ultrasound. I have an ultrasound here in February. So I have to be back here by February at the latest. But before that, like no really reason to be here. I might be gone till February. I'll probably be back a little sooner. Just kind of come chill out. Grind a bit. Either way, we'll be active in the Discord. If I'm not streaming, we'll be posting stuff in the Discord like daily as usual when I'm not streaming. But we'll kind of touch on it more tomorrow. I haven't really made too many decisive plans in that regard yet, so no point really sitting here talking about it too much. And I am out of here. Later. Stay safe. Do not get got. Don't get liquidated. Later. Later.